the government ensures the protection of private property. And it also has an obligation to protect the vulnerable members of the society. All right? Overarching role. Let me call it overarching role. The government has an overarching role. It provides a general basic security, it provides law, it provides order, it helps in the protection of property, and so on. The fourth important role that is played by the government is that one of solving disputes. Solving disputes. And when disputes are solved, then justice is ensured and ensures justice. And where there is justice, candidates, there is most likely to be peace. So the government helps to bring justice in corporate leaders. Because you know corporate leaders who are from time to time involved in scandals. The government does what? Solves disputes among the corporate leaders, disputes between companies, disputes that may arise because of financial scandals, because of fraud. And the government can also help gather enough evidence against the corporate leaders who are involved or who are involved in scandals. The government can gather enough incriminating evidence against such individuals, and that is a very important role in corporate governance. Justice. The government does what? Ensures justice. So these are four roles that are played by the government in corporate governance. And that will mark the end of our today's lesson, where we've discussed the role of stakeholders in corporate governance. The syllabus restricted us to study the three stakeholders, that is the shareholders, the board of directors, and the government. Today we have learned that the shareholders ensure only competent and reliable persons are appointed to the board. We also learned that shareholders ensures that the board of directors are constantly held accountable and responsible for the effective and efficient corporate governance of the company. Efficient, good corporate governance of the company. The third role played by shareholders is that they help change the composition of the board that does not perform to expectation. In case there are directors who sit on the board who do not perform their duties as expected, then the shareholders have a role to remove them from the board. There is also the role in relation to confidentiality. Shareholders are under obligation to maintain information that is considered secret. The company secret should be protected by the shareholders of the company. We went ahead in this lesson to discuss the role that is played by the board of directors in corporate governance. We saw that board of directors exercise leadership, they bring independent judgment, they determine the corporation's purpose and value, they monitor and evaluate implementation of strategies, policies, and management performance. The board of directors also ensures compliance to various laws, regulations, and calls of best practice. The board of directors communicates with stakeholders efficiently. Number 7, they serve the legitimate interest of the shareholders. Number 8, they regularly review processes and procedures. They also have a role to appoint the chief executive officer. And number 10, they identify key risk areas and key performance indicators. Then there is a role in relation to going concern. We've also discussed the role that the government plays in corporate governance. The first is the legislative role and regulatory role, the monitoring role, the overarching role and the role of solving disputes and ensures justice. The government helps to bring justice in corporate leaders who are involved in scandals, who are done what? Who are involved in scandals. So candidates, I'll leave you with an assignment based on what we have studied today. Discuss the role of the following stakeholders in corporate governance. A, shareholders. B, board of directors. C, the government. Thank you for taking time to attend today's lesson. When answering this question, close the notes, close the video. Try and see if you can recall what you have learned in today's lesson from your memory. God bless you. Bye-bye.
Hey there, my name is Patrick Kamau Kamure. You are a lecturer in public finance and taxation. Welcome to today's lesson where we learn more about the taxation of the business income and which we started some times back in few lessons, past lessons, where we say that we are supposed to look at the taxation of the business income, and we had 3 businesses we are supposed to look at: the sole proprietorship, partnership, and the limited company. In our previous lessons, we have covered the sole proprietorship and the partnership. So what is remaining is the taxation of the limited company, and it is the one that I want us to look at how it is usually taxed. So this is what you need to know about the limited company. That limited company is considered to be a separate legal entity from the owners, and therefore taxed on its own income at corporate tax rate. That is the first thing that you need to know, that a company is considered to be separate from the people who forms it. So when you're taxing a company, you tax the company itself. You don't tax the owners. Unlike the case of sole proprietorship, which you tax the owner, the partnership where you tax the partners, here you tax the company itself. So the following points are considered when you are taxing the company. So points considered in taxation of a limited company. There are only 2 points that you need to consider when you are taxing a company. One of them is this. 1, or A, determination of the taxable income of taxable incomes. So this is determined using either number 1, gross profit method, number 2, net profit method. So what we are saying here is that when you are determining the taxable income of a company, you just determine it in the same way as any other business, the way we have been using it. Either gross profit method, if you have not been given net accounting profit. If you have been given the net accounting profit, then you use the net profit method. It's the same thing. Point B to consider is that taxable income of company is taxed at the following tax rate. One, resident company, 30%. Number two, non-resident company, 37.5%. But note, so what we are saying is that when you determine the taxable income of a company, if it is a resident company, you tax it at 30% to get the tax to be paid. If it is a non-resident company, that's 7.5%, then you get the tax to be paid. But note, from 1st of January 2024, non-residents will be taxed at 30%. Yeah. So there was a change of the law on 1st of July 2023, which stated that come January 2024, the non-resident corporate tax rate will be reduced from that 7.5% to 30%. So it's good to know when you are taxing a company, which year is it rating to? Any year before 2024, that is 7.5% for non-resident only. And now beyond 2024 or 24 and beyond, then it's supposed to be, that is 30%. That is all that you need to know. Otherwise, everything else that we have been talking about taxation of a business, in terms of the method, in terms of the taxable operating income, non-taxable operating income, allowable expenses, and non-allowable expenses remain the same. So now we look at a question. This is what the question says. Zahari Processors Limited presented the following statement of profit or loss for the year ended 31st December 2022. We have the turnover, cost of sales, gross profit, other incomes, provision for foreign exchange gain, gain on sale of motor vehicle, release of liability, refund of excess duty, investment income gross, total income, less expenses, purchase of trademark, a design of company website, director's fee, donation to charitable institutions, depreciation expense, marketing expense, management and professional fees, general expenses, legal costs, loan repayment, allowance for doubtful debts, impairment loss of property, a net profit for the year. Additional information number one. On 1st April 2022, the company acquired the following assets: factory building, warehouse, processing machinery, rolling 4 tons, drainage system, saloon car. Number two, management and professional fee comprised development of strategic plan, tax consultancy fee, audit fee, environmental assessment fee. General expenses include installation of neon sign, car grant to a director, installation of processing machine, staff Christmas party, retrenchment costs. Number four, legal fee comprised defense against claim for breach of trade agreement, renewal of Kenya Association of Manufacturers membership fee, negotiating a bank loan, a preparation of employment contract, drafting lease agreement 60 years. Number five, release of liability was in respect of a loan obtained from one director who decided to write off the loan as it was due for over 4 years. So we are required compute the total taxable profit or loss for Zahari Processors Limited for the year ending that 1st December 2022. So we want to get the taxable income. First thing that we need to ask ourselves, which method are we supposed to use? It's obvious that for this question we are supposed to use the net profit method because we have been given the income statement with net profit, but the key we have been given the net profit, or if we are given the net loss or net income, is the same. So we'll start. So we'll start with the net profit that has been provided to us. Which we have, note that the items have been given shillings 1,000. So we have 527, 614. And then we add non-allowable expenses. in P&L and taxable operating income, not in P&L. So, as we have been doing any question that we use the net profit method, we just need to go to the P&L, look for the non-allowable expenses there. The first expense in the P&L, purchase of trademark. Trademark is not allowable. The first expense in the P&L is trademark, which is not allowable. So we add it. Then we continue. The next one is design of company website. Website is a fixed asset which we should claim capital allowance later. It's not allowable. So we add it, which we have 12,400. The other one is director's fee. Director's fee is allowed if you look at what we had said among the allowable expense initially. Donation to charity, that's allowable, we said. Depreciation, no, that is not allowable. Depreciation, which we have that 240. After the depreciation, marketing expense. Marketing is allowable. A management and professional fee, that is also allowable, we say, because it's for the business. General expenses, they are allowable because they are for business. Legal costs, unless it is stated what it is, it's allowed, which we had already looked at the non-allowable legal cost. Loan repayment, no, that isn't allowable. Loan repayment, which you have 2,600. Then the next one is allowance for doubtful debt. Allowance for doubtful debt is not allowed. It's a provision. Unless they say specific allowance, it's not allowable. Which we have 2,250. The next one is impairment loss of property. We don't allow impairment loss. We don't. So impairment loss, which we have 1,500. Seems we are done with non-allowable expense in P&L, but we need to go to the additional information, check if there is further analysis of expense in the P&L, and if there is a part that is not allowable. At the same time, in the additional information, we look for taxable operating income not in P&L. An income that is taxable and is operating but has not been included in the P&L up here. So let's see. Additional information number 1. On 1st April 2022, the company acquired the following assets. Now, those are fixed assets. First, they are not in the P&L. If you go to the P&L expenses, they are not there. So ignore. Number 2, management and professional fee comprised. Now, that is in the P&L. We have to look for non-allowables. Higher development of strategic plan. That is an allowable expense because when you plan for your business, it's income generating, it's allowable. How about tax consultancy fee? No, anything to do with tax we don't allow. Tax consultancy fee, which you have 208. The next one is audit fee. Audit fee is allowed. Environmental assessment fee, that is supposed to be an allowable expense. Why? It is not income generating. We said any expense that is not income generating is not allowable. So environmental assessment, which we have 256. After that, we go to number 3. General expenses include. Now, general expenses is in the P&L. When you go to the P&L, you find the general expenses there. They include installation of neon sign. Neon sign installation is a fixed asset. Expense incurred before you start using the neon sign, the fixed asset. Those we don't allow. So, we disallow. which we have 820. The other one is car grant to a director, also not allowed, because a grant to a director is a private, for private use. We don't allow. Which we have 2800. The other one is installation of processing machine. We don't allow installation of the process. They are fixed asset. Expense incurred before you start using fixed asset. We don't allow them. Which we have 1560. The other one is staff Christmas party. That is now allowed because we said expense for the welfare of workers, they are allowable. That's for welfare. The other one is retrenchment cost. We don't allow retrenchment cost. Expense that is not income generating, we don't allow. Retrenchment costs. Which we have 580. After that, we go to additional information number 4. Legal fee complies. Now, legal fee is an expense and it is in the P&L. We look for the non-allowable in it. Defense against breach of trade agreement. We don't allow breach of trade agreement. Breach of contract. We don't. Which we have 1450. How about renewal of Kenya Association of Manufacturers membership fee? That's a trade association. We said anything paid to a trade association is allowable. Negotiating a bank loan, no. Bank loan cost, not allowed. Which we have 1168. 68. The other one is preparation of employment contract. That is allowed. We said so. Drafting at least 60 years. We said up to 99 years this is allowed. So we are done with legal. Number 5. Release of liability was in respect of a loan obtained from one director who decided to write off the loan as it was due over 4 years. Here we said, that's an income. The income you are interested with is the one not in P&L for now. For that one, if you go to the P&L, you'll find it as one of the income in the P&L, in the income statement. So we ignore because we want the one not in P&L. Now that we are done with the addition, we come to the deduction now, less. And we list 3 items as we said. 1, non-taxable operating income. In P&L, that is 1, or in investment incomes, in P&L, and allowable expenses, not in P&L. So what we do, or we said, we start with the first 2 items, non-taxable operating income in P&L and all the investment income in the P&L. So let's go to the P&L, look for an income that is there that is not taxable or an investment income that is there. Like the first income we have is the turnover. Turnover is a taxable income. It's a taxable. After that, there is, because it involves sales, it's sales actually or revenue, what they do. Cost of sales, that's not an income. Right now we are interested with the incomes. Non-taxable investment. Gross profit is as a result of turnover and cost of sales. Other incomes which we have, provision for foreign exchange gain. Provision is actually unrealized. If it was just in foreign exchange gain or realized, then that's taxable. But provision is unrealized. So it's not taxable. We remove provision for foreign exchange gain, which we have 84,000. We deduct. The other one is gain on sale of motor vehicle. Income from selling fixed assets we don't tax. Deduct. So gain on sale of motor vehicle. Fixed assets income, we don't tax, 28,000. The next one is release of liability. What was the liability about? We were told in additional information number 5, release of liability was in respect of a loan obtained from one director who decided to write off the loan as it was due over 4 years. But that is not an operating income. So we remove, it's not an operating, it's not even an income, an operating income. So release of liability. Release of liability which you have, 32,000. Next, refund of excess duty. Excess duty is not an income. You know, you are just being refunded the tax you had paid. It's not an income. So remove. Which we have 16,000. Last three, investment income. Here we are saying that all investment income in P&L we remove. So we remove that. Investment incomes. So investment income which we have 24,000, we deduct. For now, up to this point we are done. So what remains is for us to look for allowable expense not in P&L. An expense that is allowable, but if you go to the P&L, it isn't there. If it is not in the P&L, where is it? It must be in the additional information. So let's go to the additional information and check. Number 1, on 1st April 2022, the company acquired the following assets. Well, those assets were not in the P&L, but themselves they are not allowable. What we allow in them is capital allowance or investment allowance. And there is nowhere we are told that this is the capital allowance to use. If you are not told, we said you compute yourself. So we start with, the first one is factory building. Factory building you claim at the rate of 50%. So capital allowance on factory building. In short, I'll write FB, factory building, which we said this being used for manufacturing, factory building, it is 50% of 28,800. That will be 14,400, the capital allowance. And we say that whenever you are claiming 50%, you don't consider the time. You claim for the full year, even if it is 1 day. The other rates, 25, 10, are the one that you consider time. Warehouse, that's supposed to be capital allowance at the rate of 10%. So we'll have here warehouse, which is supposed to be 10%. And then this we said we consider time from 1st April. Those are 9 months to the end of the year. So times 9 over 12 of 2800. That we will compute in a while. The other one is processing machine. Processing machine is supposed to be done at the rate of 50%. That's what we said. So to come here and say processing machine. So this is supposed to be 50% without considering time of 16,000. But we said all the expenses that are incurred before you start using a fixed asset, we add them together and they become capital allowance together. What I'm saying is this. We had an installation of processing machine here, which we disallowed because it was relating to a fixed asset. Now, because they are the same, now we add it here, which we have 1560. And then we'll claim capital allowance on the total. All the cost incurred before using, like this installation was before use. Lorry, that is supposed to be 25%. This we consider time, 9 over 12 of 3,500. The other one is drainage system. If you look at the capital allowance, we say that should be 50%. So we'll have drainage system, which is supposed to be 50% of 2,600. For the saloon car, we said it's 25%, and we consider time. However, we had said if a saloon car or sport utility vehicle exceed 3 million, we only give capital allowance to 3 million. This one is already exceeding, it's 4,840,000, so we only give 3 million. So we have saloon car. So 25% times 9 over 12 times 3. Now, those being the only fixed asset in number 1, we do the computation now. The first one is, we had already done, is 50% of 28,800. The warehouse now, 10. And then 10% times 9 divided by 12. And then times 2800. That gives us to 10. The other one, we add the 16,000. We add 1560. And then we take 50%, 8780. The other one is 25% times 9 divided by 12, and then times 3500, giving us 656.25. I want us to round off to whole numbers, so we just have 656. Then the other one is 50% of 2600, that will be 1300. 25% of 9 over 12 times 3, which gives us 562.5. So we round off to whole numbers, 563. Yeah. So we have been looking for allowable expenses not in P&L, and we were in number 1. We found fixed assets that were not in the P&L, and so we claim capital allowance. Let's check for any other allowable expense not in P&L. Number 2, management fee complies of the following. Now, all those one are in the P&L, including the audit fee, development of strategic plan. All those were in the P&L through management and professional fee. We said if the heading is in the P&L, ignore. 3 general expenses is in the P&L. Legal fee are in the P&L. Number 5 is not an expense, it's an income. So what did we say? We said if you have not been given capital allowance, we now come back here. Of the expenses that we have added back, if there is a fixed asset, claim capital allowance. We disallow the fixed asset, you claim capital allowance. So in this case, we had a website. Trademark does not qualify for capital allowance. It's an intangible asset. Website is supposed to be at the rate of 25%. And then the other one that we had was neon sign installation. And then the one installation of machine, which we had considered there. And there was no any other. So we'll come here, website, which we have 25%. Now this we haven't been told when it was acquired or utilized from. So we take 25% of 12,400. 12,400. For the neon sign, that is supposed to be 10%. Neon sign, 10%. We haven't been told when it was started being used in the business. And here we had 820. So this will be 82. Now we do the website, which is supposed to be 25% of 12,400, which give us that 100. Yeah, that 100. Now with nothing else to deduct, because we are done with incomes in the P&L, allowable expense not in P&L, we now get net taxable operating income. So we'll start from the net profit we add, and then we minus those ones. So 527,614, and then 527,614 plus 48,800 plus 12,400 plus that 240 plus 2,600 plus 2,250 plus 1,500 plus 208 plus 256 plus 820 plus 2,800 plus 1,560 plus 580 plus 1,450 plus 1168. Then this figure we minus the 84,000 minus 28,000 minus 32,000 minus 16,000 minus 24,000 minus 14,400 minus 210 minus 8780 minus 656, we minus 1300, we minus 563, and we minus 3100, and then we minus 82. That gives us 394, 155. Now, we said this, because this is a company and you tax the company itself, once you get the operating income, you add taxable investment income. Investment income. We add the taxable investment income. In this question, incomes are in the income statement. There was only one investment income, the last one, a general investment income. We said if it is not indicated where an investment income is coming from, tax it. So this one is not indicated, so tax. So add investment income which here we have been told it's 24,000. And since there isn't any other, this will give us the total taxable incomes. So we take the operating plus the investment incomes, which 394, 155, and then we add 24,000. That gives us 418, 155. Now, if you go to the required, we were supposed to get what? Compute the total taxable profit or loss of Zahari Processors Limited, and it ends there. There's no other question. But sometimes you can be asked to get the tax. Unless it is indicated it's an unresident or a foreign company, we said you tax at the rate of 30%. Because it's considered to be a resident. So tax, if tax was required, that is if it was a requirement that we get the tax, so tax will be 30% of 418, 155,000. Now we add the zeros, the one that we had quoted here, because now we are outside of these zeros we had quoted. So we'll get 30% of 418, 155,000, which gives us 125, 446, 500. And so if you are asked to get the tax, that's what you do. So the taxation of the business ends there. And which case, in case you are told to use the gross profit method, or in case you have not been given the net accounting profit and use the gross profit method, you just have the same. You just start with the sales, cost of sales, and other income, less allowable expense. Then at the end of it, you get the taxable operating income, add the investment, and then if you are asked to get the tax, you do the same. So it's all about whether you have been given the net accounting profit or not, then you know the method that you're supposed to use. So for now, we are going to stop there until our next lesson. So kindly below this video, there is some assignment question, attempt, and then you see if you can be able to do it the way we have done it. Thank you very much. How are you over there? My name is Patrick Kamau Kamure. You are lecturer in taxation Welcome to today's lesson of public finance and taxation, where we continue looking at the taxation of the business income, where, if I can give you a little of recap of what we did, is that we said that there are three businesses that we need to see how they are taxed. One of them is the partnership, is the sole proprietorship. The other one is the partnership, and the third one is the limited company. In our previous lesson, we did the taxation of the sole proprietorship. So for today, we want to go to the next business, which is the taxation of the partnership. So partnership is where we have two or more people who come together to do business together, and they don't register their business as a company. Because of that, we normally say that partnership do not have a separate legal entity from the owners, and that will mean that when you are taxing the partnership, you tax the partners themselves, not the partnership itself, because it is not separate from the partners. They are partners, and the business, they are one and the same thing. So now we want to see, how do we normally tax the partnership business? First of all, I want to write over there the introduction or definition of the partnership as I've illustrated. So we have partnership is a business owned by two or more people which is not registered as a company, and so does not have a separate legal entity. That is the definition of the partnership. But our objective or goal is to know how we usually tax the partnership business. So these are the items that you need to consider when you are taxing the partnership business. So areas to consider, or items to consider: while taxing partnership business. Number one, determination of taxable income. Determination of taxable income, and say this is done using either or A, gross profit method, or number two, or B, net profit method. What we are saying is that when you are determining the taxable income of the partnership, just like other business, and as we introduced earlier on when you are introducing to the taxation of the business today, any business, when you are determining the taxable income, you either use the gross profit method or net profit method. So the same criteria apply to the taxation of the partnership. You either use the gross profit method or net profit method to get the taxable income. We have Roman 2. Another items that you need to consider when you are determining taxable income of the partnership or taxing the partnership is the following expenses: are not allowable in partnership. I.e., salary to the partner to partners, interest on capital, interests on capital from partners to the partners, commission and bonuses to partners, drawings by partners, and any private expense of the partners. That is the second thing that you need to know, that those expenses, when they are incurred by the partnership, they are considered to be non-allowable expenses. Salaries to the partners, interest on capital, bonuses, the commission, the drawings. In short, we are saying any expense relating to the partner, like private expenses of the partner, we don't allow them when you're determining the taxable income. The third one that you need to consider, the following incomes. Are non-taxable incomes in partnership, i.e., what are those incomes that are not taxable? Interest on drawings, profit on goods sold to partners, and any other income. Any other income from partners. That's another thing, that when you're determining the taxable income of the partnership, if there's any income that the partnership received from the partners, we treat it as non-taxable. This you hear like interest on drawings, like when the partner withdraw anything from the partnership, like goods, the cash, they charge interest. That is an income to the partnership, but it is usually not taxable. Another thing is like sometimes they can have a provision, or the partners can have a provision that if a person wants to buy goods from the business, can buy and they are going to be charged a profit like any other customer. So that profit is not taxable in the partnership, and any other income that the partnership may get from the partners. The fourth one is the income distribution schedule. Distribution schedule. What does that mean? Once taxable income of partnership is determined, it is distributed to partners using income distribution schedule where they bear individual tax burden. They are taxed individually at graduated scale rates in the same way as employment income. after the distribution. The gross tax. The gross tax once determined then set-offs such as personal relief, insurance relief, and withholding tax on investment incomes are deducted. Income distribution schedule. Has the following format. So what we are saying is that about the income distribution schedule, once the taxable income of the partnership is determined, either using the gross profit or the net profit, we tax the income on the partners themselves, and we tax them at graduated scale rates. Graduated scale rates is the same as the employment income, the way we taxed the sole proprietorship, where once you distribute to the partners, because the partners are the one who bear the tax burden, you tax them individually. It is partner A, how much is the taxable income, tax individually at graduated scale rates. Partner B, how much is the taxable income, tax them individually. And then once you get the gross tax of each partner, you less the set-off. Set-off, we said that they reduce the actual tax they are supposed to pay, and they are like personal relief, the withholding tax on investment income, and insurance relief if they have life insurance cover, education insurance cover, or NHIF. Now, I want to show you how the distribution is done through the income distribution schedule or allocation schedule. So it has this format: income distribution stroke allocation schedule. We start by distributing the taxable operating income, and then we list the partners. Partner A, we are assuming partners are A, B, and then we have a column for the totals. Shillings, shillings, shillings. So the taxable operating income you would have determined using either gross profit method or net profit method. You can distribute it this way. The first one is usually the salary. So salary to partners. If partners have the salaries, if this one had a salary, you put there this one and the total. The next one is interest on capital. Interests on capital. So interest on capital for this partner, for this one, and this, if there is any. Then commission or bonus. You put on this, this, and this. After that, those three are the one that you usually post. If there is commission or bonus, interest on capital, salaries to the partners. Then you less interest on drawings. Interest on drawings. So interest on drawings here, you less if anybody withdrew the goods and they were charged interest there. Now, after you have distributed those one, the taxable operating income you'd have determined, you minus what you have distributed, minus this, minus this, minus this, but this one you add. Then whatever remains you share according to the profit sharing ratio. We call it profit share, shared according to profit sharing ratio. So you come, how much is this? This total. And then after that, get the total taxable operating income. Total taxable operating incomes means we take the salary, the interest on capital, if there is commission or bonus, less interest on doing profit share, you get the total here. You do the same for this, you do the same for that. Now, you have just distributed the operating income. Then you add taxable investment income. Taxable investment incomes shared according to profit sharing ratio. Sharing ratio. So, if you have something like rent, non-qualifying dividend, non-qualifying interest, royalty, all those, remember, withholding tax is not final. You come and share here according to the profit sharing ratio. This one, total. And then now from there, you can get total taxable income. Total taxable incomes, which will take the operating income plus investment to get the total. Operating plus investment, operating plus investment, there. And now, if you're asked about now taxing, getting the tax payable by partners, you will tax this one, A, individually on this, using the graduated scales, the way we tax a sole proprietor's income. The same case, this one, A, B, tax on this one to get the tax they are supposed to pay. So that is what you need to know when you are taxing the partnership business. And from there now, I want us to look at a question. So I read the question, then I'll show you how it is solved or computed. This is what the question says. And from there now, I want us to look at a question. So I read the question, then I'll show you how it is solved or computed. This is what the question says. Kamara, Susan, and Kubasu are a partnership, trading as Kasuku traders, sharing profits or losses equally. They have provided the following statement of profit or loss for the year ending that 1st December 2021. We have the gross profit, VAT refund, foreign exchange gain, dividend income net, a profit or disposal of furniture, rent income. Then total income, then less expenses, insurance premiums, legal fee, depreciation, repair and maintenance, VAT paid, sundry expenses, interest on capital for Kamara, Susan, and Kubasu, motor vehicle expenses, custom duty, accountancy fee, bad and doubtful debts, rates and rent, salaries and wages, net loss. Additional information number 1. Insurance premiums include 282,500 paid to insure Susan's private car. Legal fee include parking fine, settling a dispute with a customer, appeal against tax assessment, court expense for breach of contract, preparation of tender documents. Number 3. Sundry expenses include interest charged on hire purchase, cash embezzled by cashier, registration of trademark. Number 4. Repair and maintenance comprised of the following: repair of furniture, installation of surveillance camera, cost of office furniture. Number 5. The partners took goods for personal use which had cost price of 225,000. The gross profit margin was 20% as recorded in the partnership books of account. The investment allowance were agreed with the Revenue Authority at 1475,000 during the year ending that 1st December 2021. Salaries and wages included salaries to the partners as follows: Kamara, Susan, Kubasu. So we are required to have the adjusted partnership profit or loss for that year and distribution schedule of the profit or loss computed in C1 above. So we prepare the income distribution schedule after getting the taxable income. So the first question is to get the taxable income of the partnership. Question is, which method are we supposed to use? Here, we said if you are given net accounting profit, then you use the net profit method. Here we are given the net loss, which is a negative profit. That automatically means that you're supposed to use the net profit method. So we solve the question. We start with the name of the business, Kasoku Traders. Which is a partnership. We get the taxable income for the year ended that 1st December 2021. As we had said, when you are given the net accounting profit or loss or income, we start with it and then we adjust it. So we'll start with net loss provided, which we are given in shillings, and we have 2956. 2956,000 negative or a loss. Then we add, we had said when you're using the net profit method, you add non-allowable expenses in P&L and taxable operating income not in P&L. Non-allowable expenses in P&L and taxable operating income not in P&L. What does that mean? We usually start with the first item, non-allowable expense in P&L, meaning in this P&L is the profit and loss account, which is the income statement. That in this income statement, as you can see, incomes were added and expenses deducted to get the net profit, which is a negative profit anyway. So we are saying, of those expenses that were deducted, is there an expense that is not allowable? So that now it had been deducted to get the net profit. It's not allowable. It's not supposed to be deducted. We add it back. Before we go to the last one, I'll show you where we find it, because that one, as you can see, not in P&L. So we finish with this first one, as we had illustrated earlier on. Let us start with the expenses. We just follow the ones that are in the P&L. Insurance premium. Insurance is for the business, and it is usually allowable expenses. The other one is legal fee. Legal fee is also allowable, as long as they have not extended to what they entail. Depreciation, no. Depreciation is not allowable, as we have been saying, so we add it. It had been deducted, remember, and it is not allowable. 575,000. The other one is repair and maintenance. Repair and maintenance, that is allowable. It's for the business and it's allowable. VAT paid, we said any form of tax, we don't allow. Any form of tax, VAT is a tax, value added tax, is not allowable. Had been deducted to get the net profit, and it's not supposed to be deducted, it's not allowable. We add it back. Next, sundry expenses. That those sundry expenses are small expenses put together for the business, and they are allowable. Interest on capital. We had even said it here that anything paid to the partners is not allowable. Partner salary, commission, interest, drawings, and private expense we don't allow. So that one had been deducted and it's not allowable. So interests on capital, which we have Kamara, we have Susan, Kubasu. So Kamara for 7,500. The other one is 185,000. The other one is 146,000. Then we continue motor vehicle expenses. Motor vehicle expense, those are expenses to run the motor vehicle. Don't say it's the cost of motor vehicle. When you hear motor vehicle, they are the expense to run motor vehicle, like fuel, repair. Those are allowable. But if they say the motor vehicle cost, that's now the cost of a motor vehicle. Fixed asset we don't allow. So this is allowable. Next is custom duty. Custom duty is a form of tax. We don't allow taxes. So we'll add it. Which we have 227,500. Next one is accountancy fee. Those are professional fee you pay. They are allowable because they are for the business. Bad and doubtful debt. Now when you hear doubtful debt, is a provision, a general provision, because you are doubting that they might not pay, they might pay. So it's just a provision. We don't allow provision unless it's specific provision for bad debt. The next one is rates and rent. Rates and rent, those are allowable expense because they are for the business. Salaries and wages, we also said those are allowable. They are for the business. They are revenue and commercial expenses. Now look, we are done with non-allowable expenses in P&L. Now we can look for taxable operating income, not in P&L. What does that mean? It means that an income that is taxable, but it has not been included in the P&L, in the income statement up here. So meaning it didn't increase the net profit that we have down there, although it's a loss, it's a negative profit. It didn't. So if it is not in the P&L, it didn't increase this net profit. Where do we find it? We can only find it in the additional information. So we go to the additional information to check for an income not in P&L. If they happen to be taxable operating, then we are going to add. However, when we go to the additional information, there's something else we normally check. You see, we say we are done with the expenses in the P&L, but you may go to the additional information and you are given analysis of those expenses that are in the P&L. Like the last expense we had salaries and wages in the P&L. You may go in the additional information and you're told that was to the partner. Remember, salary to the partner we don't allow. So we still come back and disallow it. So in the additional information, we not only look for taxable operating income not in P&L, but we also look for analysis of the expense in P&L. If they happen to be non-allowable, we still add them. Like if you go to the additional information number 1, we are told insurance premium incurred. Now insurance premium is an expense. When you go to the income statement, you'll find it is the first expense. So now we are told that one, it includes 282,500 paid to insure Susan private car. Those we don't allow. Why? Because they are private expenses of Susan, who is a partner. We don't allow. So we disallow the 282,500. Insurance, Susan car, 282,500. Then number 2, legal fee include. Legal fee is an expense. Now, is it in the P&L? Yes. When you go to the P&L, the second expense, legal fee. Now, we need to determine if there's a component that is not allowable of that legal fee, so that we add it because it is in the P&L. It included parking fine. Parking fine, we don't allow them. Let me analyze them, then I post the one that are not allowable. Parking fine are non-allowable, so that will add. Setting a dispute with the customer, that is allowable. So if you remember what we said, legal expense related to customer is allowable expense. Then the other one is appeal against tax assessment. We say any expense relating to tax is not allowable. Relating any expense, any form of tax we don't allow. Expense relating to tax we don't allow. So this is not allowable. It's relating to tax. court expenses for breach of contract. We said that legal expense relating to breach of contract we don't allow. The other one is preparation of tender document. Now that is a allowable expense. So now let us disallow the ones that we have said. Parking fine. $150,000. Tax assessment. Expense, which we have 62,500. We have breach of contract, costs or expense, 400,000. Preparation of tender that we said is allowed. After that, we go to number 3. Sundry expense include. Now, sundry expense is in the P&L. When you go to the P&L, you will find it there. So we need to determine the part that is not allowable. It included interest charged on hire purchase. We had said interest on money borrowed is allowable. Interest on money borrowed. So hire purchase, is like you had taken an item through hire purchase, you had borrowed it, so you are paying the interest. That's allowable. Cash embezzled by cashier. We had said any expense that is not income generating, we don't allow. So it doesn't matter who embezzled. As long as it's an embezzlement, it is not income generating. We disallow. We will add it here. The other one is registration of trademark. We had said expenses relating to trademark, patent, copyright, we don't allow them. So these two, we disallow. Cash embezzled. By cashier. 565,000. The other one is registration of trademark. Which we have 281 to 50. After that, we go to the point number 4. Repair and maintenance comprised of the following. So, repair and maintenance, if you go to the P&L, you will find it. It is there, one of the expenses. So, we check the part that is not allowable. We are told it included repair of furniture. Repair of furniture, those are normal business expense and it's allowable. Don't say it's relating to a fixed asset because it was incurred after the fixed asset had been purchased. It's already allowable. Installation of surveillance camera, that is the one that is not allowable because we had said when we were looking at the capital allowance, expense incurred before you start using a fixed asset. We normally claim capital allowance on them when we are claiming the capital allowance of that particular asset. So this one is not allowable because it's part of the cost of the fixed asset, the CCTV. Cost of office furniture, those are also not allowable because they are fixed asset. So we disallow the two. Installation of surveillance camera, where we have an amount of 812,500. The other one is the cost of office furniture. Costs of office furniture. Cost of office furniture, 525,000. Then we now go to number 5. The partners took goods for personal use which had a cost price of 225,000. The gross profit margin was 20% as recorded in the partnership books of account. So partners took goods, they were charged profit. It's like the goods were sold to them. Now, they were at the rate of 20%. Now, if you go to the income statement to check whether that profit is there, it is in the gross profit that you can see in the income statement. And what did we say about the income in the income statement? At the moment, we are interested with the income not in the P&L, not in the income statement. So if an income is in the income statement, we ignore for now. So we move on to the next one. Investment allowance were agreed with the Revenue Authority at 1475,000 during the year. Remember, investment allowance is equivalent to capital allowance. Capital allowance or investment allowance are allowable. Right now, we want the non-allowable expense in P&L. So that being allowable, we ignore. Number 7, salaries and wages include. If you go to the P&L, you'll find salaries and wages there. In that salaries and wages, we are told it included the one that were paid to the partner. We said anything paid to the partner, we usually don't allow it. So, salaries to the partner. Where we have Kamara, Susan, Kubasu, which we have 600,000. We have 450, and we have 225. And that is the end of the additional information, meaning we don't have any other item we are supposed to add. Because we are done with the expenses in P&L, unfortunately, we didn't find taxable operating income not in P&L. Otherwise, it could have been in additional information. Now that we are done with the addition, remember we said now you come to the deduction. Deduction, we deduct 3 items. Less, non-taxable operating income in P&L, that is one. The second one is all investment income, or investment incomes in P&L, and allowable expenses not in P&L. So we are saying we first look for non-taxable operating incomes in P&L and all investment incomes in P&L before we look at the allowable not, because this one is not in P&L. We start with the first 2. Now we go to the P&L and look for them, but I like to delete this part here so that I can continue, and then once we are done, I can come and we distribute here. So the continuation is here. So let us go to the P&L, look for non-taxable income, meaning that in this income statement up here, there could be an income that is not taxable that was included. We remove because it increased the net profit there. We remove because it's not taxable. 2, if there is any investment income here, investment income increased the net profit, we remove it so that we remain with operating income only, as we had said. So we start with the first income, gross profit. Gross profit is a taxable income and does not have an issue because we are in the business of buying and selling the goods. So the profit we make is a taxable. But there was additional information number 5, that the partners took goods for personal use which had cost price of 225. The gross profit margin was 20% as recorded in the partnership books. We said any income to the partner is not from the partner is not taxable. So it's like the partners purchase the goods from the partnership because they are being charged the profit. We remove that profit. So profit on goods taken by partner, by partners. So here we are told the goods, the cost of the goods was 225,000. This is the cost. I want to remind you that whenever you are given margin and markup, I know you have done financial accounting or financial reporting. You are told whenever you are given the markup or margin and you want to get the profit, you must be very careful. That, remember, I want to illustrate here. Remember, markup, let me start with the margin. Margin is usually equivalent to profit over sales, which in this case we are told is 20%. So 20% stand for 20 over 100. Now we use the margin the way it is to get the profit if you are given the sale. Now, in our question, we are given the cost. The cost, we use the markup, which is the profit over cost. So in this case, then we have to ask yourselves, how much was the markup? You don't have to worry. You just need to use the margin to get the markup. How? See here we have profit over sales. Margin is profit over sales, which is 20 over 100. Profit, it is 20 then. Sales is 100 then. And here in the markup, we have the profit. So bring this 20 here because it is the same. It's a common factor in the markup and margin. Profit, 20. And then now get the cost. Remember, even when we are doing the gross profit method, we were saying a sale minus the cost of sales, we get the profit. Now, if you want to get the cost, remember here, we want to get the cost. If you want to get the cost of sales, then take this cost of sales together with the negative to the other side, and the profit will bring here. Remember, profit is positive here. When it come here, it will be negative. Cost is the negative here. When it go beyond the is equal sign, it will become positive. So it's like saying the cost would be the sale minus the profit. So in this question, do we have the sale? Yes, the sales is here, which is 100. So we take 100 to get the cost minus the profit. Do we have the profit? Yes, the profit is 20. The one that we have even used here, minus 20, meaning it is 20 over 80. So now that we have the markup, and the markup is the one that you use the cost, now we can apply it directly. This is fraction 20 over 80 times 225 because that is the cost. So we'll come here and talk of times 100 over 80. And not 100 over 80, 20 over 80. 20 over 80. We do the computation so that we can get the profit that was charged on the partners. 225,000 times this 225, let me confirm, is 225. 225 times 20 divided by 80, which give us 56 to 50. So 56 to 50 we minus. Remember, we are minusing because it's an untaxable operating income in P&L. So I now continue here. Now we go back to the P&L, look for other non-taxable income and investment. After the gross profit, we have VAT refund. VAT refund is not even an income because you just overpaid your VAT and it's being refunded to you. So we remove VAT refund. VAT refund 102,500. It is a non-taxable income. It's not supposed to be taxed. The other one is foreign exchange gain. We only say the non-taxable foreign exchange gain is the unrealized one. Unrealized we should not tax. Actually, if you were told unrealized, we should have removed because it had been included to increase the net profit and it's not taxable. But when it is cited, what does that mean? It means it is realized. So if decided it is realized, so that is taxable. We want to remove. Dividend income net. Dividend is an investment income, and we said all investment income in P&L, or investment income in P&L, we remove them. So we remove dividend income. And somebody may ask, do we remove the net or the gross? My answer is, you remove the figure that increased the net profit. The figure there, whether net or gross, right now they are saying net 562.5. The 562.500 is the one that increased the net profit that we are adjusting. So remove it, whether gross or net. The figure is the key, 562,500. Then profit on disposal of furniture. If you remember, we said income from selling fixed assets we don't tax. So had been included in the in the income statement, they increased the net profit, it is not taxable. So profit on furniture. So profit on furniture, which we have 591,000. The other one is rental income. We said all investment income in P&L we remove. Rent is an investment. We remove rent income, which we have for 15,000. And that is the last income in the P&L. So we are done with non-taxable operating income in P&L and all the investment income in P&L. Now we look at the last part, allowable expense not in P&L. An expense that was supposed to be deducted in the P&L in the income statement to get this net profit, it had not been deducted, meaning this net profit, it is overstated. So we need to remove it. If it is not in the P&L, where do you find it? You find it in the additional information. Let us go to the additional information for an expense allowable not in P&L. Now we start with number 1, insurance premium. Now remember, we want expense not in P&L. Insurance premium is in the P&L. Leave it. Number 2, legal fee. Legal fee, if you go to the P&L in the income statement, you'll find it there. Leave it. Including, don't say, like in the legal fee, we are told it includes setting a dispute with the customer and also preparation of tender. Remember, those we said are allowable. Don't go to the P&L and you won't find them and say now they have not been deducted. No, all of them are in the heading of the legal fee. So they are all inside the legal fee that is in the P&L. So as long as the heading is in the P&L, ignore it. So number 3, sundry expense is in the P&L. Repair and maintenance is in the P&L. Number 5 was about gross profit, not even an expense. Number 6, investment allowance were agreed with the revenue authority to be 1475,000 during the year. Now, investment allowance or capital allowance, it is allowable. It had not been deducted, because if you go to the P&L, you will not find it having been deducted there. So we deduct. It is allowable expenses, not in P&L. Investment allowance written as that, in short, or CA for capital allowance for the year. For the year. For the year. For the year, which is how much? Here we are told it was agreed to be 1475,000. 1475,000. We continue getting the allowable not in P&L. Number 7, salaries and wages include. Salaries and wages is in the P&L, and there is no other expense that is not in P&L. However, I want to mention this. Sometimes you may not be given this investment allowance agreed. Like you may not be given that point number 6. Let's say it is not there. If you are not given, make sure you come back to the expenses that you disallowed. Check if you have a fixed asset. Remember, fixed asset we disallow so that we come and allow the capital allowance. Allowable expense not in the capital allowance. So if you are not given this, like in this case, we had which fixed asset? Here we had installation of CCTV. If you remember, we said capital allowance is at the rate of 10%. And then the next one is the installation of CCTV. There was office furniture, cost of office furniture here. Remember, office furniture, we are supposed to claim at the rate of 10% as well. So if you are not given this capital allowance, we could have come here and say capital allowance on installation of CCTV camera, 10% of the figure that we have, 812,500, we minus that figure. Then capital allowance on furniture, 10% of 525,000, we get the amount before. But if you are given the capital allowance, then you are okay. So with that one, then we are supposed to now get, since there is no other, we have considered every factor here, we can get the net taxable operating income. So taxable operating income, I want to do that first. So what we do, we start with this negative, we add all these figures, we minus these figures so that we can get the net. So I'll start. The first one is 2956 negative. Remember to minus negative. 2956,000 plus now positive 575,000 plus 233,750 plus 407,500 plus 185,000 plus 146,000 plus 227,500 plus 155,000 plus 282,500 plus 150,000 plus 62,500 62 did it first plus 62,500 plus 400,000 plus 565,000 plus 281,250 plus 812,500 plus 525,000 plus 600,000 plus 450,000 plus 225,000. Then now we start minusing 56,250. We minus 102,500 minus 52,500. We minus 591,000 minus 415,000. We minus 1475,000. So giving us 125,250. So we have 125,250. Now, having gotten the taxable operating income, having gotten the taxable operating this one, I want you to get the difference with the sole proprietorship and also the company. For the partnership, we don't add investment income here. Investment income, first we have to distribute this operating income among the partner until here we get the total taxable operating income. So the total we get here would be the same as this, and then the investment income we add here. So the investment income are not added here, they are added in the distribution schedule. So for now, this we cross it that way for the partnership, because now we need to distribute. Now after that, we have answered required one. We were supposed to get the adjusted partnership profit or loss for the year. Here it is. Required two, distribution schedule for the profit or loss.
Welcome, learner, to our human resource management subject, and we are looking today at Frederick Hasberg's two-factor theory, and we want to look at it in terms of the two aspects presented, two factors presented by Frederick Hasberg. Frederick Hasberg's two-factor theory is also referred to as motivation hygiene theory. Is also referred to as motivation hygiene theory. And in 1959, Frederick Hasberg proposed a two-factor theory, and according to Hasberg, there are some factors that result in satisfaction, while there are some other job factors that may prevent dissatisfaction. So according to Hasberg, the factors which enhance satisfaction should be maintained, and the factors which prevent dissatisfaction should be addressed to ensure that employees are motivated within a working environment. So Hasberg classified these job factors into two categories, and these two categories are hygiene factors. So you have the hygiene factors. You have the hygiene factors and motivational factors. Hygiene factors and motivational factors. And according to Hasbach, within a given environment, there could be some aspects built in the job itself. And these aspects that are built within the job itself, according to Hasbach, these are the satisfiers. And that is what Hasbach proposed, that managers have to be able to find out, organizations have to be able to find out what are these inbuilt factors within the job in relation to motivational factors that may enhance employee motivation, and they can be cultivated and they can be put in place, and workers can be encouraged to be able to perform. So we want to look at the two factors. So we will start with the hygiene factors. Hygiene factors. Hygiene factors. These hygiene factors that were brought out by Hasbach, the hygiene factors are those that may, in the working environment, if they are not addressed, bring dissatisfaction within that particular setting. And Hasbach proposed that an organization has to address those hygiene factors. And what are some of the hygiene factors according to Hasbach? So according to Hasbach, the hygiene factors in an organization may be things like pay. And when it comes to pay, number one, pay. So this could be pay structures, and pay levels. Pay structures and pay levels. So what Hasbach was suggesting, if an organization wants its employees to perform, then they have to look at the hygiene factors in relation to pay. And in this case, you are looking at pay structures, you are looking at pay levels, you are looking at commensurate pay that should be given to employees depending on their performance. Then the next thing could be company policies, organizational policies, organizational policies and procedures. So an organization has to look at the organizational policies and procedures in terms of the guidelines that are available within the work environment that govern the relationship between workers, supervisors, managers, and how work is done in that particular work environment. So when that is now addressed, then there are also aspects of fringe benefits, benefits. So these ones are the extra perks that are provided to workers. For example, an employee in a given organization could be told, if they are in an environment where parking is a challenge, that worker could be having a specific area where they park. So when they come to the work environment, they are able to find ready parking. They don't have to move up and down looking for parking. They could, for example, have good physical working conditions. So physical working conditions, physical working conditions should be looked at. So when it comes to the working environment, physical working environment. So this physical working environment may encompass things like maybe the machines, the tools, the equipment that employees are using. So here, machines, tools should be in good condition. Should be in good condition. So if an employee is working and the machine they are using, the machine the employee is using, and the equipment the employee is using is in good order, then that employee will enjoy even doing that particular work. So when you give employees equipment that are current, modern technology, even that worker will want to come and see how they can also be able to use those equipment. Then number 5, you have status. Employees should be recognized. And appreciated. Recognized and appreciated. So if you have designations or titles, then an employee will feel recognized, will feel appreciated, and this can also help in enhancing that employee's, for example, position. Then you also have interpersonal relations. Interpersonal relations. Interpersonal relations. Interpersonal relations. So this should be cordial. Cordial relations should be cultivated within a given environment. Interpersonal relations. An organization should ensure that the way workers relate to each other, the way they also relate with managers and so on, the way subordinates and superiors relate, that should be cordial relations. Then you have the aspect of job security. Job security. So this could, for example, be given in terms of contracts, stable appointments, among others. So an organization should be able to provide job security, ensure there is work for employees, and that way employees can put in more effort. So this could be some of the hygiene factors which must be addressed within a given working environment to ensure that workers are able to be motivated to be able to work in terms of their areas of operation. Then you have now the second part. That one was hygiene factors. Then you have what we are calling motivational factors. Motivational factors. Motivational factors, or sometimes they were referred to as satisfiers. Motivational factors or satisfiers. So we have looked at the one side. These aspects are not inherent in the job. These are things which are around the job. So Hasberg recommended that in terms of the motivational factors, an organization has to look at the job itself now. The organization has to look at the job itself in terms of how that particular organization is able to work. So in terms of motivational factors, there is the first one, which is recognition. Recognition. So the employees have to be recognized in the organization. The organization, like now, if you have a general manager, you have a maybe plant manager, they have to be recognized within that particular organization, and they have also to be recognized in terms of their accomplishments. In terms of accomplishments, which must also be, which have to be appreciated. For example, an employee has invented some way of doing work that has to be recognized in a function, and if possible, that worker could also be given some reward in relation to that particular recognition, and that one will motivate that worker and other workers to be able to work effectively. And then number 2, there is the aspect of sense of achievement. What happens, Lana, human nature is that if somebody does something and there is an element of achievement, right? For example, if an employee is given a target, okay? An employee is given a target, for example, you have got 1,000 acres of land that is arid, for instance, and you put there a team and they are supposed to be able to translate these 1,000 acres into farmland and be able to make harvests from there. So these kind of workers in that kind of a team, they will have a sense of achievement if they achieve this target of translating arid land that is 1,000 acres into arable land that can be able to sustain life and be able to feed people and so on. Then there is the element of growth and promotion. Growth and promotion. Growth and promotion. So an organization has to provide opportunities for advancement. Opportunities for advancement. If workers have achieved, if workers have performed, then these workers should be promoted, for example. So these ones could be, for example, promotion to higher grades. So that will make those employees who have been promoted to move to higher grades. It will make these employees to be able to work hard, and other employees will also want to work smart so that they can also grow in terms of their career expectation, as the case might be. And then it is important that employees within organizations are also made responsible. Responsibilities. So we are looking at motivational factors. So if you have a team, for example, if you have a team and you make them responsible for production, for example, responsible for production, so they will set targets, they will bring together their schedules, they will decide when they are supposed to maybe stop the machine and do overhaul. And when they have those responsibilities as a team, if they achieve or if they are challenged to be able to achieve challenging targets and so on, then that particular kind of a group can be able to operate, can be able to be motivated in terms of a team, in terms of the members and so on. Then there is the element of meaningful work. Meaningful work. So that work should be worthwhile. Whatever employees are doing should be worthwhile, something they can be proud of. For employees to be proud. Employees should be proud of what they are doing. If they are doing things that are making lives better, if they are doing things that are changing the environment, that are changing the society, they are, for example, producing products that are being used to save lives. They are making products which are used to feed people who are hungry, dress or clothe people, provide intervention measures and so on, assist humanity. So this meaningful work will make it worthwhile, and it is a motivational factor for employees, and it is one of the satisfiers that management has to make sure within a given work environment, employees are motivated. So having looked at now hygiene factors, we have also looked at motivational factors. What are some of the implications of two-factor theory? Implications of two-factor theory. Implications of two-factor theory. So we want learner to look at what are some of the implications of the two-factor theory. So one, managers and supervisors must create a conducive work environment for effective motivation. effective motivation. 2, employees should be involved in decision making, Number 3, why this Frederick Hasberg's two-factor theory is critical. Jobs must be designed. To enhance employee motivation. So what you are saying, Lana, in this point is that if you look at the hygiene factors, these are factors which are outside the job. But if you look at the motivational factors, these ones are factors which are inherent within the job. Then progressive recognition should be made to employees, to encourage motivation. So you have a situation where employees have performed well, and it had been agreed that if you achieve, it is important that you are recognized. So the recognition should be made. And number 5, organization should combine intrinsic and extrinsic rewards. Organizations should combine intrinsic and extrinsic rewards in their motivation. So what happens, it is not only the extrinsic factors, intrinsic and extrinsic factors are important. So organizations must seek to strike a balance in terms of how they may want to motivate their workers. And then it's also important, number 6, job enrichment. Should be used to provide employees with vertical job loading factors, to motivate workers, through challenging tasks. So, Lana, these are just some. Job enrichment should be used to provide employees with vertical job loading factors. So here is where higher level jobs tasks are brought down to encourage employees to be able to perform in a given organization, to achieve that sense of achievement for the meaningful of the work, so that the work is also exciting. So, Lana, summary of Frederick Hasberg's two-factor theory. We have looked at Frederick Hasberg's two-factor theory, and we have indicated that Frederick Hasberg's two-factor theory may also be referred to as motivation hygiene theory. It was proposed in 1959 by Frederick Hasberg, and according to Hasberg, there are some job factors that result in satisfaction, while there are other job factors that prevent dissatisfaction, and Hasberg classified them as hygiene factors and motivation factors. We have had a look at some of the hygiene factors, and we have indicated that some of those hygiene factors are pay, where you are looking at pay structures and pay levels. We also have hygiene factors like organizational policies and procedures and guidelines. We also have fringe benefits or extra perks, number 3. Number 4, physical working conditions like machines, tools should be in good conditions to facilitate smooth working. Number 5, status, where we have said that employees should be recognized and appreciated. Number 6, interpersonal relations should be cordial. Number 7, job security should be provided to workers where they are appointed in contracts that are stable. So, Lana, those are some of the hygiene factors. Then when it comes to motivation factors, which we have indicated like satisfiers, number 1, there should be recognition where employees should be recognized for their accomplishments and appreciated. Number 2, sense of achievement, where workers are given targets that if they achieve, they also feel they have conquered and achieved something. Number 3, growth and promotion opportunities should be provided to workers. Then number 4, responsibilities, where team production could, for example, be encouraged. Number 5, meaningful work should be made available, where workers feel that it is worthwhile to be able to perform those tasks. Then we have also looked at the implications of the two-factor theory, and we have indicated that it has several implications, including number 1, managers and supervisors must create a conducive work environment. Number 2, employees should be involved in decision making. Number 3, jobs must be designed. Jobs must be designed to enhance employee motivation. Number 4, progressive recognition should be made to employees to encourage motivation. Number 5, organizations should consider combining intrinsic and extrinsic rewards in their motivation processes. And number 6, job enrichment should be used or provided to employees with vertical job loading factors to ensure that workers are able to perform higher level activities, to challenge them and to give them an opportunity to make a contribution and feel that their knowledge and skills have been applied. So before we finish, you have an assignment, Lana. Assignment, and your assignment today is assess the application of Hasberg's Frederick Hasberg's two-factor theory in human resource management. Human resource management. So Lana, that is your assignment. Assess the application of Frederick Hasberg's two-factor theory in human resource management. So I want to take this opportunity to thank you very much for being attentive in our lesson today. Thank you. Welcome, learner, to our continuing lessons in human resource management. Today we are looking at motivation theories and practice of human resource management, where we are looking at classical theories of motivation, and we are looking at Douglas McGregor theory X and theory Y. Now, this Douglas McGregor is known for proposing theory X and theory Y, which are two assumptions about human nature, and the theory X and theory Y on which are theory X and theory Y on how managers perceived and handled employee motivation. The theory X and the theory Y were developed by McGregor in the 1960s. And these theories have extensively been used to inform decisions in management and in human resource management. So what Douglas MacGregor did, when it comes to Theory X assumptions are the negative sides of the assumptions where some managers had the assumptions about workers. And Theory Y is the positive side, according to MacGregor, that there are some managers who made assumptions that, for example, in Theory X, that employees are inherently lazy. And these employees may dislike work. These employees must be coerced to work. So when managers have that kind of a view about workers, then those supervisors or managers will handle employees with coercion or a dictatorial management style. But on the other side, where an organization, a supervisor or manager views employees with assumptions of Theory Y, then the Theory Y is the opposite of Theory X. And in Theory Y, it is presumed that individuals will even like to do work so long as the environment is created to have them to work effectively. And what Douglas MacGregor proposed is that managers should emphasize on the Theory Y assumptions to be able to create environments that help employees achieve their objectives. So we can have a look at Theory Y and Theory X, and then we see what were some of the assumptions that were made under Theory X and Theory Y. So here you have Theory X assumptions. Theory X assumptions. Okay. Now, when it comes to Theory X assumptions, as you have said, Lana, this is the positive side. Okay. This is Theory Y, Theory X. Theory X is the negative assumptions that supervisors or managers may have regarding workers. And what are some of these assumptions? What are some of these assumptions of Theory Y? We have just indicated that in terms of a working environment, a manager may argue that the average worker is inherently lazy. So this kind of a manager makes an assumption that a worker is inherently lazy, for example. 2, dislikes work. 3, cannot take responsibility. 4, should be coerced. Should be coerced. So that means forced. Should be coerced or forced to work. Should be coerced or forced to work. 5, will avoid work at all options. So if an employee has an option to avoid work according to these assumptions, a manager assumes that this employee will avoid work at all options, at all options, or maybe opportunity. So these are the kind of assumptions, and these are not all the assumptions. These are some of the assumptions that were proposed by Douglas MacGregor, that when you look at a work environment, there are some managers And these managers may have this kind of assumptions about workers. And when they have this kind of assumptions about workers, then these kind of managers are likely to adopt what is called a dictatorial approach to managing these particular employees within the working environment. Then, on the other hand, there is now the theory X assumptions. Theory Y assumptions. Theory Y assumptions. Now, the theory Y assumptions, this was the negative. So theory Y is the positive side. And when it comes to the positive side, according to Douglas McGregor, employees, the average employee will work willingly. The average employee will work willingly. So what is important is for the management to create a conducive environment. So according to McGregor's theory, when it comes to the theory Y assumptions, what are some of these assumptions? One, workers can take initiative for their work. Two, workers are responsible so long as the right conditions are created. Workers will seek extra, will take initiative and seek extra responsibilities. So what we are saying, Lana, if you look at the theory Y assumptions according to McGregor is arguing that this is the progressive side, and workers can be what is called highly ambitious. Creativity is inherent among the workforce and so on. So these are the issues. On the theory Y assumptions, if managers make an assumption that the average worker will take initiative for their work, the workers will be responsible so long as the right conditions are created. Workers will take initiative and seek extra responsibilities. Workers are highly ambitious. Workers are willing to be involved in decision making. And when it comes to performance, these employees are able to provide output. So what McGregor provided is that Douglas McGregor, as a note learner, McGregor indicated that it is the responsibility of management to create the right work environment, for employees to operate in. So according to Douglas McGregor, looking at theory X and theory Y, Douglas recommended theory Y, for progressive managers. So for motivation purposes, McGregor Douglas provided that managers who are progressive should be able to create a conducive environment, and once they create a conducive environment, the assumptions on which they should base decisions on regarding their workers could be the theory Y assumptions, and encourage employees to be able to perform. So those are the issues that surround the theory X and the theory Y assumptions in relation to a work environment. So we can go through this, learner, slowly again. We have looked at Douglas McGregor theory X and theory Y, and we have indicated that in the 1960s, Douglas McGregor is known for proposing two assumptions about human nature, and these two opposing assumptions were theory X and theory Y, and according to Douglas McGregor, these were the set of assumptions that managers perceived their subordinates or their work environments, and the kind of the managerial decisions they took were influenced by these assumptions. Then we have looked at theory X assumptions and indicated that the theory X assumptions were the negative assumptions that managers could make regarding their employees, and that would then influence the kind of management styles they adopted. And we have seen that the theory X assumptions may include: one, average worker is inherently lazy; then two, an average worker dislikes work; three, an average worker cannot take responsibility for their actions within the work environment; and then four, an average worker needs to be coerced in order to be able to work, and coercion here we have said is forced. And then number five, an average worker will avoid work at all options or at any opportunity. So this then will make managers who are managing employees with this kind of a perspective to adopt a dictatorial or autocratic management style. So when workers are handled with that kind of a style, sometimes it may create challenges. So that is as far as the theory X assumptions are concerned. And when it comes to theory Y assumptions, this is the positive side. And the average worker, according to the managers who perceive workers this way: one, workers can take initiative for their work; two, workers are responsible so long as the right conditions are created for them; then three, workers will take initiative and seek extra responsibilities; four, average workers are highly ambitious; and five, creativity can be inherent within workers or it can be cultivated. So those are the theory Y assumptions, a set of which some managers may perceive their subordinates and now be able to sometimes adopt what is called a democratic leadership style or management style to be able to get work done. And according to McGregor Douglas, it is the responsibility of management to create the right environment for employees to operate in. And Douglas McGregor highly recommended managers to increasingly adopt the theory Y approach to be able to create a democratic management style to be able to achieve both employee and organizational objectives and motivate workers to their level based in terms of performance. So Lana, before we finish, I want to leave you with an assignment. And your assignment for the lesson today is describe Douglas McGregor's theory Y theory Y, theory X, and theory Y, as it is used in management. As it is used in management. So learner, this is your assignment. Describe Douglas McGregor's theory X and theory Y as it is used in management. So we have come to the end of our lesson today, where we were looking at Douglas McGregor, theory X and theory Y, and we have looked at the theory X assumptions and theory Y assumptions, and also your assignment. So thank you very much. We hope to meet in the next lesson.
We have answered required 1. We were supposed to get the adjusted partnership profit or loss for the year. Here it is. Required 2, distribution schedule for the profit or loss. So distribution schedule is the way we had said. So we'll come and now distribute whatever we have determined. So I'll delete just part of this. And then I'll also change the names here because they are 2. And then I'll also change this. Let me delete this. So I'll call this the partnership name, Kasuku Traders Partnership. Income distribution or allocation schedule. And then here we noted there were 3 partners, by the way. So I'll delete this so that I can introduce the 3 partners. I'll give them the initials. As you have seen, there's Kamara. So I write KA to stand for Kamara, Susan, SU, and Kubasu, KU. And then totals because of the space. So shillings, 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 shillings. So we had said the first thing we normally distribute is the salaries to the partner. So you just need to go to the question and determine if there was salaries to the partner. When you read through from the income statement, there was none. Additional information number 1, 2, 3. It was in point number 7. So you come and say now salaries to the partner, Kamara, 600,000. Susan, 450. Kubasu, 225,000. And now we get the total. We add the 3 to get the total. So 600,000 plus 450,000 plus 225, which give us 1275,000. There. Then the second one is interest on capital. This one, when you go to the income statement, you have to remember the 4 that we talked about first. The salary, interest on capital, commission or bonus, there's interest on drawings, those 4. So you follow them that way. The next one is the interest on capital we had written. So we check. It is there in the income statement, interest on capital. So we'd have here 47,500. The other one is 185,000. The other one is 146,000. And now we get the total. So 407,500 plus 185 plus 146, which give us 738,500. Then the other one that we had here was the commission or bonus to partner. But I'm very sure as we went through the question, there were no commission or bonus to the partner. So if it is not there, ignore, just assume it. You go to the 4th one. less interest on drawings. In the question, we didn't have interest on drawings to the partner, none. So now we do the last one, fifth one, which we said is the profit share. Profit share. So profit share, how do you get? We said we take the operating income, this one, of 125,250 minus what you have distributed. You have distributed this and this, which is 75,000 and also 738,500. Then what remains, you share according to the profit sharing ratio. That's what we said. Profit share, you share according to the profit sharing ratio. If you look at the first paragraph, is where we have the profit sharing ratio. Kamara, Susan, and Kubasu are in partnership trading as Kasuku, sharing profit and losses equally. They are three, each to get a third. So first one, a third. The other one, a third. The other one, a third. So let's see what remains. We'll start with 125,250, and then we minus 1275,000, and then we minus 738,500. Then we have negative. It will be negative. We have negative 1888. So I'll extend this a bit. 250, which is a negative. Now each is supposed to get a third, so you divide by 3. Each to get 629. 416. I want to round off to, because it's 416.6. 417. So 417, which is a negative. Same case here, because it's for each, and the other one is 629, 417. All they are, remember, are negative. So from there now, we need to get the total taxable operating income. Operating income. So total taxable operating income would mean we take this plus this minus this, because it's a negative. The same case for everyone. So we start with 600 for the first one, 1,000 plus 407, 500 minus 629, 417, and then we get positive 3. So this would be 378, 083 positive. And then now we go to the second one for Susan, for 50,000, and then we add 185,000 minus 629, 417, 5583. Then for Kubasu, 225,000 plus 146,000 minus 629, 417. This is a loss of 258, so negative 258, 417. Then now we get the total, which would be 1275,000, and then we add 738, 500, and then we minus 1888, 250, which we get 125,250, 125,250. And that answer, you'll find it is starting with the operating income, because remember we have been distributing this operating income. Actually, we can even write it here, 125,250. So at the end, the total column should tally with the operating income, because we have distributed through salary, interest, and profit share. Once you do that, now we said the investment income come here. You add the taxable investment income. taxable investment incomes. So for the taxable investment incomes, so we need to go to the question, especially in the income statement, determine if we had an investment income, and then we share if it is taxable. The first investment income in the income statement is the dividend income, which we are told it is net. What we say is this: if you are given an income like dividend or interest, and you're not told where it's coming from, always assume it's a non-qualifying dividend or non-qualifying interest. Like this one, they have not indicated where it's coming from. So being non-qualifying means that the withholding tax was not final. We need to tax it further. So the dividend that we don't put here are the one that we indicated as exempt or qualifying, because exempt are not taxable. And here we are talking about taxable. Qualifying, withholding tax, if it's final, you are not supposed to tax it again. So only non-qualifying. So this one, being that it has not been indicated, we assume is non-qualifying, so it should be here. So dividend income, where we have 562,500, and then it is net. Remember, we say that for non-qualifying dividend, if you are told net, withholding tax is 15, meaning they have already deducted 15, meaning this is 85%. Remember, we said you only tax the gross. So if this 85, 100 will be what? To get 100, multiply by 100 over 85. And then profit sharing ratio, each was to get a third. A third. So it will be 562, 500. We multiply by 100, divide by 85, you get 661, 764. Uh, 765, we round off, and then divide by 3, which comes to 220, 588. Now with that one, we have distributed the dividend. There is another investment income, rent. We said if you're not told where the rent is coming from, you assume it's a commercial rent, so that you tax it further. So here we have not been told. And then for the rent, you must minus the allowable expense relating to rent, repair, caretaker salary for the rental. But for this question, we haven't been told whether there were any expense relating to rent. So we distribute the way it is. So rent income, which we have a 415,000, and then profit sharing ratio, each to get a third. So that would be in total 415 divide by 3, giving you 138,333. 138,333. And then since there is no other investment income, we can now get total taxable incomes. So total taxable income, we do them this way. If the operating is positive, that's the time that we add investment. Like this one is positive. But if it is negative like this, we don't add. We cross it there. Remember, we say that a loss from one activity can only be deducted against profit of the same activity. So operating for this guy, this person, they had a negative. It will be carried forward to next year. So next year, when they generate a profit, he generate a profit or she generate a profit from the operating, she deduct this loss. So for this year, he will be taxed on the investment income only. So for this one who have positive are the one that we add. The negative we don't add, we only add the positives. So we start with the first one, 378,083. 083 plus 220, 588, 220, 588, and then we add 138, 333, which give us 737, 004. We go to the next one, 5583, and then we add to 20, 588, to 2588, and then we add 138, 333. We get 364, 504. For this one, remember we said we don't add the negative carry forward to next year, we only add the positives. So 220, 588 plus 138, 333, which we get 358, 358, 921. And then we go to the total, 125 to 50 plus 661, 765, and then we add 415, 415,000. So giving us 1202, 015. Yeah. And the question ends there. And this total cannot be the same as this way because this we didn't add. So this we carry forward to next year. So as per the question, that is where we stop. And that is how we determine the taxable income of the partnership, and we do the distribution. For now, we are going to stop there until I see you in our next lesson, where we are remaining with one business, that is the limited company. We see how limited companies are usually taxed. Thank you very much. However, make sure that you do the assignment that is being shown at the end of this video. Thank you very much.
Hello class, welcome to topic number 5, where we are looking at share capital. So this is the first lesson of this topic, where we are going to look at the following issues. We are going to describe share capital. We are also going to look at the various types of share capital that we can have. We are also going to look at the alteration of share capital. Then in this lesson, we shall conclude by looking at the reduction of share capital. The reduction of share capital. So class, we can begin on the first item, where we are describing share capital of a company. The share capital of a company will be prescribed in the company's constitution, where they describe what the share capital of this company will be. Now, capital becomes share capital if the capital is divided into units that we have previously described as shares. So if the company's capital is divided into these units that we are referring to as shares, then we say our company has a share capital. That the capital of the company is divided into units that we are referring to shares, then that is the share capital of the company. Now, the company's share capital can be put into various categories, what we are considering as the types of share capital of the company. Types of share capital. The first type that we may have is what we refer to as the registered. The registered, also known as the authorized, share capital. The registered or the authorized share capital. This, as the name registered suggests, this is the capital with which the company is registered with. The capital being divided into units that we are referring to as shares. It is also described as the maximum amount of capital that the company is allowed or authorized to issue. Hence the reference to authorized, the word authorized meaning the amount which the company is allowed by law to issue. That authorized amount is the amount with which the company has been registered with. Just to make this note, the fact that we have been registered with a particular amount of share capital, it does not mean that in the future we may not alter, we may not change that amount of share capital. That it is possible that in the future, this company may be changing, either to increase or to reduce its registered or authorized share capital. Now, the company will be at liberty to either issue the whole or simply part of this amount that is their registered share capital. From this registered share capital, it is possible to have what we are calling the issued share capital. The issued share capital. This is also known as the allotted share capital. It is the share capital that the company has issued to the members. It is the subscribed share capital of the company. It is the amount of shares that members have taken up from the company and they have undertaken to give a consideration for. So, out of the company's registered share capital, we noted that it is not compulsory for the company to issue the whole of it. So, that part that they have issued, that part that has been subscribed for, that part that members have taken up and have committed to pay for, then it is that part that we are referring to as the issued share capital. Now, where this is part of the registered share capital, there is a balance that remains, which we are referring to, number 3, as the unissued share capital. The unissued share capital. That this is that part of the company's registered capital that members have not taken up, that the company has not issued. So this can be the subject matter of future issuing of shares by this company. Now, I would want us now to concentrate more on this issued share capital in our fourth type. Out of the issued share capital, we can have what we call the called up share capital. It is usually a portion of the issued share capital. If class, you can recall from our previous topic where we talked about calls on shares, where the directors were empowered by the articles to make a demand that members pay part of the shares that they have taken up in the company. This is the subject matter, or rather this is the capital, the type of share capital on the basis of which calls have been made. That it is that part of the issued share capital that the company directors have made a call in respect of. It is a portion, or it could be the whole of the issued share capital that the company has already made a demand to the holders of those respective shares that they make a payment in respect of the shares they have taken up. Still on the calling of shares, we may also have a portion of the issued share capital that we are describing as uncalled up share capital. Uncalled up share capital, where we are saying that this will be that portion of the issued share capital that the company directors have not demanded. The company directors have not requested members to make payment for. So if the issued share capital, in respect to the issued share capital, if the whole of the issued share capital has not been demanded for to be paid, then the balance will be the uncalled up share capital. Then, on this called up share capital, we can have what we are referring to as the paid up share capital. the paid up share capital. If it is not paid up, then we have what we are referring to as the unpaid up. The unpaid up share capital. The unpaid up share capital. That in respect to the amount that the directors have called up, that which they have already received, then it is referred to as the paid up share capital of the company. This is actually what the company has. It is the money they have actually received in respect of the shares that they have issued. Then there is that part that we have already demanded that members pay, but we are yet to receive. The company is yet to receive that part that they have demanded that members pay in respect of the shares they have. That part not yet received but demanded is referred to as the unpaid up share capital of the company. Now, class, we have some very special category of the uncalled up share capital that we refer to as the reserve capital, also known as reserve liability, It is a portion of the uncalled up capital. It is a portion of the uncalled up capital that the company, by a special resolution, resolves that they will not be calling that part except in the case of a winding up. Now, the idea behind not calling up this amount of capital is seen as a way of securing creditors. It gives assurance to creditors that there is still some amount of capital that members are liable to pay towards their shares, that in the event of an insolvent winding up, then there is some faith to creditors that there is still some portion of capital that the members have not yet paid up and are committed by a special resolution that will not be capable of being called up except in the course of winding up a company. So if we could describe the interrelationship between these categories, then you could have something like this, that if this were to be considered to be the registered share capital of the company, then this registered share capital of the company can either be the issued or the unissued share capital of the company. Then in respect of this issued share capital, we may have this as the called up share capital, then we have the uncalled, up capital of the company. Then in respect of this called up, then we have what we are describing as the paid up capital. Then we also have that part that may be unpaid, up. So this small diagram can be very helpful to describe the interrelationship between or amongst these various categories of share capital that we have described. And it is in respect of this part, that is the uncalled up capital, that we now create our reserve capital. That it is a portion or the whole of the uncalled up capital that the company resolves by a special resolution that we will not call that part unless we have a winding up process going on, where that part is seen as securing the interest of any creditors who may have a claim against this company in case of an insolvent winding up of the company. So class, these are the various types of share capital that we may have. Now, I want to look at the possibilities of a change alteration of share capital, alteration of share capital. Now, if a company would have this sort of scenario, that we have been registered with a capital of 1 million, let that be million Kenya shillings, and that 1 million Kenya shilling is divided into 100,000 shares, where the value of a share would be shillings 10, this being the capital, and these are the units that the capital is divided into, then this is the value per unit. alteration of capital will refer to any transaction that will have the effect of increasing or reducing this capital. Any transaction that will have the effect of increasing or decreasing the units that the capital is divided into, or any transaction that has the effect of increasing or decreasing the value per unit. So these transactions could include the following. So ways of altering share capital. Ways of altering share capital. So the following transactions can be good examples of how capital can be altered. One of them would be redemption of preference shares. So these have to be the sort of preference shares that are redeemable that we have previously looked at and in our previous topic. We could also issuing of additional shares. Issuing of additional shares is a possibility. We also have possible transactions like a conversion issue, conversion of debt to shares, We can also possibly have consolidation of shares. The reverse is also possible, the subdivision. It is also possible to have a subdivision of shares. It is also possible to have a subdivision of shares. And other transactions like diminution of capital. Now, what is happening here? What nature of transactions do we have, and what effect are they going to have as far as alteration of capital is concerned? Now, if part of our share capital was represented by redeemable preference shares, where redemption is the aspect of the company buying back that proportion of shares that is the redeemable preference shares, then it would have an effect of ultimately reducing our capital and the number of units that we have as our issued share capital when the company buys back or redeems the redeemable preference shares. Now, we will have some conditions relating to the redemption of preference shares. For instance, the shares themselves have to be issued as redeemable, that they have to have that fact, that right given to the issuing company that the company can buy them back. It will be a requirement that these shares should be fully paid, that no redemption will be done for partly paid preference shares. That companies may be issuing new shares so that the consideration they get for the issue of the new shares is applied to the redemption of the preference shares. Otherwise, where the redemption is not out of a fresh issue, then it can be redeemed out of reserves. We can have the redemption of preference shares being done out of the capital reserves of this company. We also have this second transaction that has the effect of altering the company's share capital, which is issuing of additional shares. So where our capital was presently 1 million divided into 100,000 shares, this company may choose to increase its share capital by issuing additional shares. So they could be issuing an additional 100,000 to take its share capital to 2 million. The transaction will have the effect of we now have an increased capital with increased units of shares. It is also possible that we can have this third transaction where debt is converted into equity or converted into shares. This will be in respect to particular debt instruments, let's say debentures, that they were issued carrying the right to convert into equity. So when such a transaction happens that we have debt converted into equity in respect of shares, then the effect is that we have added additional equity in respect of shares. It is also possible that we can have a consolidation of shares. The consolidation of shares would be where we take a cluster, a number of shares, and then convert them or add them up into a single share, resulting into a share of a bigger value. For instance, if this company were to consolidate all its shares to take up two 2 shares to form 1, then we will have our shares reducing from 100,000 to 50, where the value of a share would be 20. The company would have consolidated the shares, merged them up 2 to become 1, where now the number of shares, the units drop by half to 50,000, then the value per share goes up from 10 to 20. Now that's a consolidation. The reverse is the subdivision of shares, where we have the present value of share being the present shares being divided into smaller units. For instance, if our shares were to have every share be divided into 2, then we will have our number of units increasing from the present 100,000 to 200, where the value per each unit now falls from 10 to 5. Now that's a subdivision of shares. All these transactions have to be authorized by the Articles of Association, and as you note, they are all resulting into a change or an alteration of the company's share capital. Let me discuss the last of the issues in this lesson, and that is the reduction of share capital. Reduction of share capital. To understand reduction of share capital, I prefer we begin by asking ourselves the question why we may need to reduce. Why would we want to reduce our share capital as a company? Now, if you could trace the basis from this equation where we say that the company's capital is the equivalent of its assets less its liabilities, assuming that our company had no liabilities, then it is true to say that the company's assets is the equivalent of its assets if L is equals to 0. If our company had no liabilities, then it is true to say that the company's capital is the equivalent of its asset. This equation should be seen or should be kept true, that with reference to our books, the capital amount of the company should at all times be the representation of the value of the assets that this company has. It so happens that sometimes the company's assets may fall in value. For instance, where we have had an accident for which we have not received any compensation, then the company's value of assets may fall. Imagine in the event of a fire. We have a company building which was previously represented as the company's assets that has now been burned and destroyed, and no compensation for the same. Then we would say C is no longer equivalent to A as a result of the decline or the fall of the value of A. So where the value of A has gone down, to maintain this equity between C and A, then it may also become necessary to take down the value of C, which we are referring to as the reduction of capital. Now, to the second question, how will we be reducing this capital? What particular transactions may we carry out to end up with a resulting C being reduced? Now, one of the possibilities that we may have, which is the easiest of all the possibilities, is where the company extinguishes. To extinguish or reduce the unpaid up capital, of the company. So that part of the company's share capital that is unpaid up, that we have made a demand to members to pay, but they are yet to pay, then we can extinguish or reduce that liability, where we are simply telling members that they no longer have to pay. They no longer have the obligation to make that payment to the company. The effect is that our C reduces. We also have other possibilities where the company cancelling part of the paid up capital. Cancelling part of the paid up capital. This would be in the event where we do not have unpaid up capital, that the company's called up capital has also been paid up. Then in that eventuality, then we may cancel out a portion of that part of the company's capital that is already paid up. Then finally, we have the last of the options available. It would rarely be an option for us, but it is possible, where we have a company paying off capital back to members. Paying off capital back to members. This would be an extreme case where the company is saying we are going to pay back what we have received from members as capital contributions. Anyway, as extreme as they sound, we are saying these are possibilities that are available to the company to execute a reduction of capital. Now, I want us to look at the process that we will follow if we will need, as a company, to reduce capital. The process of capital reduction. The process of capital reduction. First and foremost, this process has to be authorized by the Articles of Association. Must be authorized. It must be authorized by the Articles. That the Articles must permit. That unless we have the permission of the Articles, we may not reduce capital. So that in a case where we have a company whose Articles do not allow, and the company wishes to, then they would have to begin a further distance where they have to amend the Articles first to allow them to reduce their capital. Then they would now begin the process of reduction of capital. So once we have secured the permission of the Articles to reduce capital, then the company will convene a meeting of members to approve the reduction. So we have the approval of the reduction. Approval of the reduction by members. Approval of the reduction by members. Now, members will be approving this reduction at a members' meeting by passing a special resolution. They pass a special resolution. The resolution is known as a resolution for reduction of capital. Special resolutions will always be supported by a 75% majority vote of all those members present and entitled to vote. So if we get this threshold of support at the members' meeting, then the resolution is rightfully passed and the reduction of capital is successfully approved by the members. Now, once we get this approval by members, then we begin a court approval process. Courts approval of the reduction. Court's approval of the reduction. So the company has to make an application through the directors to the courts to approve the intended reduction. Now, the reason why we involve the courts in the reduction process is that there are particular groups that may be adversely affected by the reduction of capital, that the courts have to confirm that the interests of these specific groups have been catered for. For instance, we are looking at the interests. We are looking at the interests of creditors. We are also looking at the interests. We are also looking at the interests of minorities. We are also looking at the interests of minorities. Remember, with a 75% majority approving the reduction, it does not mean everyone else is very happy about the reduction. There is still a balance of 25% that may be seriously affected by the reduction. So we afford them an opportunity to have their issues protected. So in protecting the interests of the creditor, the courts will be asking the company whether we have any creditors of the company that are objecting to the reduction. So if there is any objections we have from the creditors, the question is, what has the company done to secure the interest of that creditor? So the company could be saying that we have paid off all those objecting creditors, or we are providing a guarantee that all these creditors will be paid after the reduction. That is in a bid to ensure that no creditor will be compromised by the reduction of the capital. So the same will happen for the minorities. If any minorities are objecting to the reduction, then again the court confirms how the interest of such minorities has also been respected or observed by this company. So if the court is okay that the creditors' interests are not prejudiced and the minorities' interests will not be prejudiced by the reduction, the court will issue an order. The court issues an order. The court issues an order confirming. The court issues an order confirming the reduction. The court issues an order confirming the reduction. In some extreme cases, the courts will go to an extent of protecting the interest of third parties, members of the public, where they may require this company to change its name, to add to its name the words "unreduced." We may have an order that the company is to add these words "unreduced," so that if our name was previously AB Limited, the name of this company that has reduced capital may now become AB Limited and reduced. This order is to the effect that this is to be part of our name for a specified period of time, so that anybody who sees this, then they may know that we have previously reduced capital as a company. But it is not a very common order. The court will also be conscious of the adverse effects that the company may get by notice being sent that they have previously reduced their capital. So this may not be the usual case that companies will be ordered to put this or to have this as part of their name for a specified period of time. So we now have our court approval for the reduction. The next thing is that we will now have to give notice to the registrar. We will now have to give notice to the registrar that we have reduced our capital by a special resolution of members and receiving an approval of the court. So how will this registrar know that we had a meeting approving? We shall be giving them minutes of the meeting of members in which the special resolution was passed. How do they know that we received a court order approving the reduction? We shall be giving them a certified copy of the court order approving the reduction. So once the registrar has that, then they are convinced that the due process has been followed in reduction of capital. They will now finally be registering the reduction. Registration of the reduction. Registration of the reduction of capital. So, dear class, that is what we are covering in this first lesson on share capital, where we have defined what share capital is. We have also looked at the various types of share capital that we can have. Then we have looked at the various transactions that constitute an alteration of the company's share capital. Then we have also looked at the process of reduction of capital, where we began by asking ourselves why we were reducing capital and how we would reduce capital, and then finally the process to be followed. So thank you very much. Hello class, welcome to lesson number 2 of our topic number 5. In this lesson, I will be considering the raising of capital. The raising of capital by companies. Now, you will notice that companies will have two options in the raising of their capital, that they can either raise capital from the members of the public, where they are looking at external sources of capital, particularly share capital. Then they also have an internal options where they can be raising additional capital from within their existing membership. So I want to list a number of ways by which companies will be raising capital, which we shall subsequently be discussing. So we have methods such as a direct invitation, a direct invitation available to the company. Offer for sale is also an available option to the company. The company could also do placing. We could also have a bonus issue of shares. It is also possible that we have a rights issue. It is also possible that we have a rights issue. We can also look at the possibilities of a conversion issue. It is also possible that we can have a scrip issue. So these are some of the ways that are available for this company to raising share capital. We shall see some of them are external sources, while others will be internal sources. So where this capital is being raised from an external source, we shall be looking at this process known as the flotation process or floating of shares, which is the legal process by which by which a company avails its securities to the public, by which a company avails its securities to the public. You notice, the moment we talk about availing securities to the public, then we are particularly referring to only public companies. Private companies may not have this option available to them. They will not be approaching the publics to subscribe to their securities. So some of these methods involve a public invitation in a flotation process. Others will not be involving a flotation process. So we want to look at them one by one and see which ones of them, which of these methods will be involving the flotation process and which ones will not be involving the flotation process. So beginning with the first of those methods, which is the direct invitation, the direct invitation. In a direct invitation, the company intending to raise capital prepares a prospectus. They will be preparing a prospectus, which is an information tool, a document by which the company will be giving information to possible subscribers, to the members of the public about itself. So in this document, the company will tell the members of the public about how long they have been in business, who are the managers of this company, what kind of business they are involved in, how much capital they wish to raise, what number of shares are they issuing, value per share, rights of these shares, a lot of information that is supposed to give the potential subscribers enough information on which they are to base their decision on whether they are going to buy these shares or not. So once the company has prepared prospectuses inviting the public to subscribe for these shares, there is a risk that the members of the public may not respond to this prospectus issue overwhelmingly. For instance, if through a direct invitation where we are issuing a prospectus inviting members of the public to buy securities, let's imagine we want to raise 100 million worth of share capital by way of a prospectus issue. There is a risk that the subscriptions we get from the members of the public could only maybe be at 70 million. Sometimes it could be worse. We may be falling at 70. So that we have a serious deficit with respect to the target of 100 million. Then it therefore becomes necessary that this company doing a direct invitation to raise share capital may now be required to do what we call underwriting the issue. In underwriting the issue, the company gets into contact with an underwriter. Underwriters will usually be investment banks or insurance companies, which will be giving a commitment to the company issuing shares that for some commission, we refer to as the underwriting commission, that they will take up a percentage or the whole of the capital or the whole number of shares that will not be taken up by the public. So possibly they are saying, we will take up everything else that is not taken up in the issue. So if this company invites the members of the public to subscribe to a share capital worth 100 million and the public only take up 70, the underwriting arrangement could be such that the underwriter is to take up the balance of 30 million that has not been taken up. So the underwriting gives the issuing company some confidence that at the end of the day, once we invite the public, even if they do not subscribe to the entire amount of share capital that we wish to raise, then the underwriter can come in and provide the whole of the balance or part of the balance as will be agreed in the underwriting contract between the issuing company and the underwriter. So something that should come out very clearly in the direct invitation, this company that wishes to raise capital by way of a direct invitation will have to go into the details of preparing and issuing a prospectus. Now, in the prospectus issue, there is a lot of publicity that this company has to create, that they have to do a lot of advertisements through TV, through radio, through newspapers, just to sensitize the public. Let the public be aware that we are in the process of raising our capital, that we're in the process of issuing additional shares. Let the public know that there are shares that are available for them to subscribe. And then, of course, with the risk that we run, that all these shares may not be taken up, the issuing company may also have to arrange for underwriting, where they get an underwriter to commit to them that any portion or part of any portion of this share capital that may not be taken up by the public, then the underwriter will provide consideration for such amounts. So that is the direct invitation. We have another option that is available to these companies, which is the offer for sale, an offer for sale. In the offer for sale, the company that wishes to raise capital involves a second company that we shall refer to as the issuing house. So what happens is that the company raising capital will allot, they will allot all the shares, to the issuing house. They will allot all shares to the issuing house, so that this issuing house now goes on to take up what the company raising capital would have done. So the issuing house takes up responsibilities such as preparation of the prospectus. They will also be arranging any underwriting if necessary to underwrite the issue. So in a way, in the offer for sale, the company wishing to raise capital gets another company to do the work for them. So this second company is the issuing house. It is the second company that now takes up the responsibility of preparing prospectuses on behalf of the company that wishes to raise capital. If underwriting is necessary, it is the second company that also takes up the responsibility of ensuring that the issue is underwritten by an underwriter. So that when we now have applications made for shares of this company, then the issuing house will be renouncing their allotment in favor of any applicants who apply for these shares. So the main difference we notice between these two processes, in the direct invitation, the company raising capital goes directly to the public, prepares the prospectuses by themselves, and if any underwriting is necessary, they also underwrite by themselves. In the offer for sale, they get assistance. They transfer the responsibility of the issue to a second company known as the issuing house. How so? That they are allotting all the shares to the issuing house, which in turn now issues them to the public. By preparing a prospectus on behalf of them, they also arrange underwriting if necessary on behalf of them. And should we be receiving any applications for the shares of this company, which had been previously allotted to the issuing house renounces their allotment in favor of the applicant that they receive in respect of these shares. Then we have the third option that we may have, which is the placing option. In the placing option, we still have our company that wishes to raise capital by way of issuing shares. But something different you will notice this time round, this company will not be going to the public directly, but still they will be using an intermediary. The issuing house will still be involved. So in the placing option, the company allots the shares, the company allots the shares to an issuing house which then offers them to specific persons, or institutions or organizations. Now, in this case, because we are not inviting the publics directly, then we are saved from the inconveniences and all the costs of doing a prospectus. Then we shall also not be faced with the risks of doing an underwriting. That what the company that wishes to raise capital is doing is, they are allotting all these shares to an issuing house, and then they give them the responsibility of having these shares offered to possible or willing investors. So the issuing company approaches individuals who maybe they have a relationship with, who maybe they are sure that if they pitch to them the idea of buying the shares of this company, then they will. Because of the fact that they are not going to the publics directly, then in this placing process, we are excused from preparing prospectuses. We only prepare prospectuses when the issue is a public issue, when the issue is targeting the public or a section of the public. But in this case, because we are attending to individual institutions, individual organizations, individual persons, then we are excused from the preparation of prospectuses. Now, these two methods will be the preserve of public companies because the public is involved. As you will already be aware of, private companies by their articles restrict the invitation, actually they prohibit the invitation of the public to subscribe to their securities. So they cannot be doing a direct invitation, they cannot be doing an offer for sale. But a placing option is available for them because the publics are not being invited directly. Now, we have these other options available. If you look at these three options, the companies were targeting outside sources to increase their share capital. In the remaining of the sources, then the company will be targeting internal sources to increase its share capital. For instance, a bonus issue. A bonus issue. What will be a bonus issue? This is the issue. This is the issue of additional shares. The issue of additional shares to existing members in proportion to their current holding, for no direct consideration. We are issuing additional shares to existing members in a proportion. We are getting as much as we have, depending on the number we have. So we are issuing these shares in proportion to their existing shareholding. And most importantly, what makes it a bonus is that they are not giving us any consideration directly. So the question should be, how do we finance a bonus? Now that we are not getting anything directly from the receiving members, where do we get the money to finance a bonus? Bonuses are financed. Bonuses are financed by reserves. E.g. retained earnings. A reserve such as retained earnings could be a possible reserve from which we could be financing a bonus issue. It is because of this reason that a bonus issue is also referred to as a capitalization issue. Bonus issues are also known as a capitalization issue because they present to us an option through which we can capitalize our reserves. For instance, when we plow back our retained earnings and make them part of our capital by issuing or by executing a bonus issue, then we capitalize. The result is that we have capitalized that reserve. Now, for a bonus to be effected by a company, there are some conditions. There are some conditions that are necessary. Conditions for a bonus issue. Conditions for a bonus issue. That there will be some conditions that the issuing company must meet before they proceed on to effect a bonus issue. One of those conditions is that it must be allowed by the articles. We must get the permission of the articles. So the articles must allow. So if the articles of our company do not anticipate a bonus issue being executed by the company, then the bonus cannot be issued. Once we have the articles of the company allowing, then the bonus must be recommended. The bonus must be recommended by the board. The bonus must be recommended by the board. So it comes out of a recommendation of the board that we can increase our share capital by capitalizing a reserve, such as the retained earnings. Then with the recommendations, it must be approved. It must be approved by members. It must be approved by members by a vote of the members. So we're imagining a meeting of members where the members are presented with a motion to capitalize reserves such as the retained earnings on the recommendation on the board so that they approve such transaction. Beyond the approval of the members, we're also saying that the company must have sufficient capital. The company must have sufficient capital so that the capitalization should not be a way of creating enough capital for us to work with. This should be seen as extra always. Not that we were already suffering capital crisis or one of the sources of capital we are looking into is a capitalization issue. No. It should always be we are capitalizing to go over and above our present requirements. That we are already not lacking. So when we are in capital problems or capital deficits, then a capitalization issue will not be effected or cannot be effected. The other conditions that we must also be meeting is that it must be within the ratio, allowed by the articles. It must be within the ratio allowed by the articles. So the articles will also go on to tell us how many shares per existing share can be issued as a bonus. So can we get a bonus of 1 share for every 10 existing shares we have? Do we get a bonus of 1 for every 20 shares we have? So the bonus must always again be paid within that ratio that the articles are allowing. Then we are saying that if this company effects the bonus issue, then notice must be given to the registrar. Notice must be given to the registrar. If it so happens that this is a public listed company, then notice has also to be given, or we also have to seek the approval of the markets regulator. In our specific case, we are talking about the Capital Markets Authority. That if the company, in this case, executing a bonus issue is a public company quoted in the Nairobi Stock Exchange, for them to effect a bonus issue, they will need the approval of the Capital Markets Authority, which is the regulator of the publicly traded companies. So that is the bonus issue and the conditions that we must observe to effect a bonus. The other option we have is the rights issue. In a rights issue, the company is issuing additional shares. The company is issuing additional shares, to existing members, in proportion to their current holding, at preferential terms, in proportion to their current holding at preferential terms. So one of the differences you would see between a rights issue and a bonus issue is that in the bonus issue, we were not paying anything, so to speak. We were not giving any consideration for the shares we were receiving in respect of our current shareholding. In a rights issue, we are giving something, but this thing that we are giving, the consideration that we are giving, is at preferential terms. Usually, for companies that are traded, listed companies, the rights issue will be executed at a price lower than the market value. So that if the company in question is a listed company and the current market price at the stock exchange is 50, maybe we could be doing a bonus issue at 45. The idea is we are giving an opportunity to existing members to take up more shares at a lower price. That if these members were to buy these additional shares in the market, they would be paying the 50 shillings. We are now giving them an option to take up more at a lower price, say 45, say 46. Anything lower than the market price would be considered to be a preferential term, would be considered to be a better term offered to these members. So rights issue will have the effect of, again, increasing the company's share capital, but being more so a special opportunity given to existing members to increase their shareholding in the company. That this option is given to the members of the company, that they can take up additional shares at preferential terms by paying less than they would be paying in the market. Now, when the rights issues are being effected by a company, the members will be given 3 options that they can exercise. That members will have 3 options in respect to the rights. Now, the first option is that they can exercise the rights. In exercising the rights is that they can actually buy those additional shares that the company is offering them in respect to their current shareholding at that preferential rate that they are being given. The second option they have is where they transfer the rights, or simply selling these rights. Now that I have an opportunity to buy these shares at a lower price, it could be the case that I have no money to buy, or I am not interested in taking up any additional shares, but they can transfer that right to another member or a non-member to buy such shares that are being offered as part of the rights issue. Then the third option they have is to ignore the rights. That is the third option. It appears to be the worst of the options that the members can exercise, where the members are simply doing nothing about the rights. That they are not going to buy additional shares that are being offered at preferential terms. They are also not going to transfer their rights to anybody. So the rights simply expire, and those members forego the option to take up these additional shares at the preferential terms that had been given by the company. So if this is a publicly traded company, that is, it is listed in a stock exchange, then to execute a rights issue, this company will require the approval of the Capital Markets Authority, which is the regulator of publicly traded companies. So that's the rights issue. The other option we have is doing a conversion issue. The conversion issue results out of securities, usually of debt nature, that have the right to be converted into equity. That we have issued debt securities, maybe in the form of debentures, and we create rights on these instruments, on these securities, that they are convertible at the option of the holder into equity. In such cases, then we are talking about the converting of debt securities, into equity. Converting of debt securities into equity. So the holders of these debt securities, once they exercise this option that debt has been converted into equity, then the result is that we have an option of having raised our share capital, that our share capital is increased as a result of this new equity created as a result of the converted debt. The point is, for this conversion issue to be effected, the articles must be allowing for such conversion, and the particular debt instrument being converted must have the rights of conversion into equity. Then finally, we have the scrip issue. In a scrip issue, this is an option. This is an option to members. This is an option to members to receive dividend by way of additional shares in the company. So at the year end, once we have declared our dividends that we shall be paying this much per share held, the company can give options to its members via its articles that in our company, we have afforded members the option of taking up dividend by way of additional shares. So for mathematical representation, if we have shares valued at shillings 5, and the dividend payable to an individual member for mathematics purposes being 5,000, then we can be giving an option to this shareholder. Instead of receiving your 5,000 Kenya shillings in the form of cash dividend, we are giving you the option of taking up additional shares. So where the value of a share is now currently 5, then this 5,000 is affording this shareholder some additional 1,000 shares. So in this case, this member is being given this option that instead of taking up in cash form the 5,000 dividend, you have the option of taking up 1,000 additional shares in this company. This is a scrip issue. The effect is that we have given ourselves an option of raising share capital as a company. So, dear class, this is the issues that we wanted to consider in this lesson regarding to raising of capital. We have looked at the various options available to the company, particularly the direct invitation, where the company was targeting the public, issuing a prospectus as well as underwriting if necessary. We have looked at the offer for sale, where the company was transferring the responsibility of the issue to a second company. We have also looked at the placing option, where again the company transfers the responsibility to a second company, but this company does not go to the public directly. It goes to specific persons or specific investors and offers those shares to them. Then we have seen these other methods where we are looking inwards. We are looking at internal sources where the company can possibly do a bonus issue by offering members additional shares for no direct consideration. We have also seen a rights issue being a possibility where we are offering more shares or additional shares to members, but this time round at a preferential rate. Then the possibilities of a conversion issue where the company is offering holders of debt securities the right to convert them into debt. The net effect being that our share capital, equity capital, is increasing. And finally, a scrip issue to those members who are receiving dividends, that we are giving them an option to take up additional shares instead of cash dividend. The result being, again, increasing the company's share capital. So class, that brings us to the end of our lesson 2 on matters raising capital. Thank you. Hello class, welcome to lesson 3 of topic number 5, which is share capital. Share capital. In this lesson 3, we will look at the prospectus. We shall look at the company's prospectus or prospectuses. And in respect of the prospectus, we will define the prospectus, look at the essentials of a prospectus. Then we will look at the contents of a prospectus. Then we will look at criminal liability arising out of the issue of prospectuses. Then I will also look at the civil liability arising out of the issue of prospectuses. Then I also intend to look at the purchase of shares, the purchase of own shares by a company. Then finally, we shall look at payment of dividend and the dividend rules or rules relating to the payment of dividends by a company. So let's begin by where we want to describe or define a prospectus. Now, when you look at our act, that is the Companies Act of 2015, it does not give a very clear prescription or description of what a prospectus is. It talks about a prospectus, being a notice, being a circular, or any advertisement issued by a company, offering securities to the public, for subscription. So quite a number of words have been used to describe this document, that it is a prospectus, that it is a notice, it is a circular, it is an advertisement. Should be an R there. It is an advertisement issued by a company offering securities to the public for subscription. Now, what we conclude is that there will be no specific format that this document, that is the prospectus, may take. That it could be in the form of a notice, it could be in the form of a circular, form of an advertisement. Simply put, no specific format that we expect of prospectuses to be taking, provided that it is a document containing those specific contents, as we shall be discussing later on today. And then what it is doing, that this document is inviting for subscription. It is inviting the members of the public to subscribe for the securities of the company. So the test of what the prospectus is not much on the format of the document, but specifically what the document does. what the document does, that it is a document inviting for subscription, inviting the public to subscribe for the company shares, and that of its contents. That the contents and what the document does is the test of what a prospectus shall be. Now, there is this term that we are using here, the term offering securities of the company, offering securities of the company to the public for subscription. Now, the term offering, as used in this description, is not in its strict legal sense. In the strict legal sense, when you talk about the prospectus offering for subscription, you would imagine the issue of the shares or the prospectus being an offer for the company shares. It is actually not. It is an invitation to treat. It is inviting, the prospectus invites potential subscribers to make offers by making an application for the company shares. It is until when these applications are received, when the company makes an allotment, the offer by way of application is accepted by the company by allotting shares. So the prospectus in itself is an invitation to treat, not an offer. Though in this description, we are talking about the prospectus offering. So that use of this term offering is not in its strict sense. We are also making reference to this word public. And the question would be, does a prospectus have to make an invitation to the entire republic? Does it have to make an invitation to each and every person? Now, common law, by way of courts' decisions that we have received from courts, the suggestion is that the reference to the word public does not have to include everyone. That the invitation to the public will be sufficient even where a section of the public is targeted. So if we have a company issuing shares and the only places where this prospectus has been circulated is Nairobi, now the question will be, was that a public issue? And the idea is, since Nairobi is part of the general public in Kenya, then that is a public issue of the prospectus. Even a section of Nairobi residents receiving the prospectus, it would still qualify to be an issue targeting the public. So this document is taking no specific form. We are judging what it is by what it does and its contents, that it is issued inviting members of the public to subscribe for the company's securities such as shares. And then we look at the contents as we shall be discussing them later. Now, let's go to the essentials. When a prospectus is issued, there are specific things that it must come along with. There are specific things that the prospectus must demonstrate. The essentials of a prospectus. For instance, we are saying that all prospectuses must be dated. They must contain a date. They must indicate a date. And the idea is this date that shall be contained in the prospectus shall be assumed, shall be considered to be the date of issue of the prospectus. All prospectuses must be signed. All prospectuses must be signed. Now, one of the persons to sign the prospectus will be any person named as a director. Any person named as a director by that prospectus must be signing the prospectus. The idea of them signing is considered to be them giving an authority or giving their consent for the prospectus to be issued, which is important. Any person or any expert who was issued a statement. Any expert who was issued a statement. So sometimes when you're issuing prospectuses, you may want to get some experts to give their opinion on certain matters. It could be about the evaluation of the company's assets. It could be about the prospects of the company's business. So when you get such experts giving statements about this prospectus, then you also get them to sign the prospectus, and particularly a copy of the opinion or the statement that they have endorsed. This endorsement or this signing is seen as giving consent to that statement being issued to the public for consumption. The other thing that will also be part of these prospectuses would be endorsements or attachments. Attachments to the prospectus. Attachments to the prospectus. This could be any expert opinions or expert statements that have been given in relation to the issue of the prospectus. It could also be financial statements of this company issuing the prospectus. Then finally, we must also have a statement. We must have a statement issued. Statement to the effect, a statement to the effect that a copy of the prospectus, has been issued to the registrar. That a copy of the prospectus has been issued to the registrar. Now, this is the issuing of the copy of a prospectus to the registrar is a protective measure that the registrar's office is a public office that should receive this document for purposes of confirming, for purposes of ensuring that this document is compliant to the provisions of the law. So that if you are issuing a copy of the prospectus to the public, and we have a statement in the prospectus that says, we have also given this copy to the registrar, that the registrar has authorized the issuing or the sharing of this document to the public, then it inspires confidence to the public that this document that is being issued by this company in respect of the subscription of particular securities that they are issuing is a compliant document. So this should be some of the essentials we are expecting this prospectus to manifest. Now, I want to discuss the contents of the prospectus. Contents of the prospectus. Contents of the prospectus. Now, if you know why this document is being issued, then it becomes very easy to anticipate some of the contents or the contents that you expect to find in this document. We are issuing a document to the public to share with them all the necessary information that they need to enable them to make a decision on whether they are going to buy, they are going to invest, they are going to subscribe for the shares of this company or any other form of security that this company could be issuing. So imagine yourself as the investor, and we are issuing a document that should give you information sufficient enough to base your decision on whether you're investing or not. So question would be, what kind of information do you expect that we should share in that document? Now, part of the contents or part of the information that we should be sharing in this document will be information relating to the company itself. We shall also be sharing information relating to the management of the company. We shall also be sharing information relating to the securities that we are issuing, so that all these pieces of relevant information will be enough or will be consumed by the potential investor in determining whether they are going to invest in the securities that are issued by this company. So what are some of the things we're expecting to find? You expect that the prospectus will tell you something about the company's preliminary expenses. The prospectus will also talk to you about the remuneration of promoters. This prospectus should also tell you about any founders' shares that have been issued to management. It should also tell you about the particulars. It should also tell you about the particulars of directors. So what are the names of these directors, addresses, including occupation, So what else do they do when they are not directing this company? This could be a good test for the experience and the exposure these directors have. You would also need information to do with the director's remuneration. The director's remuneration. So how much are they paid to manage this company? You would also give information about director's share qualification. So does this company require their directors to take up some minimum number of shares as part of their directors' share qualification? It makes the directors part of the membership of the company. You may also have requirements relating to the securities themselves. So the rights conferred by the shares. So we are going to buy shares. What rights do these shares that you are issuing grant us? Opening and closing of subscription lists. So when can we start applying for these shares, and when will they close? They should also tell us about the minimum subscription. The minimum subscription. This is an amount out of the total amount of capital that the company wishes to raise. They will indicate the minimum amount that they must or they consider should be raised in this issue. That is the amount that the company is thinking would be good enough to have some working capital, good enough to meet any costs of this issue may have come with, any pre-incorporation, any preliminary expenses that may have been incurred. So they should also be stating this, the minimum subscription expected from this issue. It will also be important to be told about the auditors of the company, if any have been appointed, auditors of the company. We can also be told about any material contracts. Entered into matters relating to shares that have been issued otherwise than on a cash basis. Basically, what we are saying that this prospectus should be giving us information relating to who manages this company. What kind of shares are we buying? What prices? When do we start buying? What kind of rights are they giving us? Then the company itself. How long have you been doing business if less than 3 years? Have you entered into any material contracts that you think we should be disclosed in this prospectus that we should consider when investing, when purchasing the securities of this company? Basically, it is information good enough to enable a potential investor to base their decision on whether they are subscribing or not subscribing for the shares of this company. Now, the issuing of a prospectus, actually the preparation and the issuing of a prospectus is subject to very strict rules, such that we have a lot of liability that has been created in relation to the preparation and the issuing of prospectuses to ensure that companies comply with these rules. There will actually be liability on the part of directors, part of experts, or any persons who have been named as directors in this prospectus for non-compliance with some of the requirements of the Act relating to the issue of the prospectus. It is that liability that I now want to discuss in relation to the issue of prospectuses. Let me begin with the criminal liability. Criminal liability relating to prospectus. Criminal liability relating to prospectuses, where we are saying that it is an offense to do what? So for certain things that we shall do relating to the issuing of prospectuses, the Companies Act considers them criminal, considers them an offense for which a fine shall be imposed on the defaulting officer of the company. For certain things that we may omit during the preparation and the issuing of the prospectus, the Companies Act considers them an offense by way of an omission for which a fine shall be imposed on the liable officer of the company. So I want us to consider some of these things that under the Companies Act are considered a criminal offense, either when done by the company or the company's responsible officers, or when not done in relation to the preparation and issuing of prospectuses. Now, we are talking about one, it being an offense to issue a prospectus, a copy of which has not been presented, to the registrar, a copy of which has not been presented to the registrar. This is just a legal expression to say you are not supposed to issue prospectuses when you have not given a copy of that prospectus to the registrar. So when the company's officers proceed on to issue prospectuses to the public, when a copy of that prospectus has not been received by the registrar, then that is going to be an offense for which the company officers responsible are going to be liable to pay a fine. It shall also be an offense to invite for subscriptions, of company securities, subscription of company securities unaccompanied by a prospectus, So this rule or this offense is simply prohibiting any invitation to the public for which no prospectuses should be issued. So if you are targeting any public invitation, then that invitation must be accompanied by the issuing of a prospectus, where we are saying it is going to be an offense to the responsible company officers where they are inviting for subscription of the company securities where a prospectus has not been issued, where a prospectus is not accompanying the invitation for the subscription. To further offenses, where we're saying it is also going to be an offense to, issue a prospectus, containing an expert statement without their consent, Now, what this offense is prohibiting is the issuing of prospectuses that purport to contain opinions or statements given by experts, where the consent of that expert has also not been obtained. So if you are to issue a prospectus with an opinion of an expert accompanying it, then also get the consent, the endorsement of that expert to go along with the prospectus, so that this offense says or prescribes that it is going to be criminal to issue a prospectus containing a purported statement of an expert whose consent does not accompany the prospectus. The other offense is that it is going to be an offense to issue a prospectus it is going to be an offense to issue a prospectus without the necessary attachments or endorsements or annexures, as we call them. An attachment is also known as an endorsement or an annexure. So what kind of attachments are we thinking about? So those prospectuses that have expert statements must also be accompanied by the written consent of such expert, such that it is criminal not to have that attached. Prospectuses that are carrying with them financial statements, those financial statements will be an annexure, will be an attachment to the prospectus, such that it shall be an offense not to have those financial statements attached to the prospectus if this company is to issue that prospectus. To more of those offenses, we have some more. Should be number, this is 4, should be number 5. It is an offense to issue a prospectus. It is an offense to issue a prospectus containing an untrue statement. It is an offense to issue a prospectus containing an untrue statement. That it shall be criminal to issue a statement or to issue a prospectus containing false, incorrect, wrong statements. This is intended to protect the consumers of the information from misrepresentations. That you are not going to make prospectuses and issue with it misrepresentative statements, statements whose truthfulness you cannot account for. Now, this liability shall be to the person issuing the statement. That the person issuing the statement that turns out to be untrue shall be the person to whom criminal liability in respect of the untrue statement goes to. Now, we have some special circumstances where this person's issuing untrue statements could also have some reasonable defenses against any action brought under this offense, where we are saying a statement was issued in the prospectus, and this statement turned out to be untrue. The statement turned out to be a false statement. Now, the person issuing the statement could come in with some very good defenses, such as where they are saying they had all reasonable grounds to believe that the statement was true, and actually they believed the statement to be true. In that case, their liability for the untrue statement would be extinguished. We also have circumstances where an untrue statement has been issued and the person issuing the untrue statement has also withdrawn such statement and given reasonable public notice, so that their defense is, at the time when they issued the statement, they believed it to be true. When they realized that the statement was not true, they withdrew the untrue statement and issued reasonable public notice of their withdrawal of the untrue statement. So class, for all this conduct or omissions, there is going to be criminal liability imposed on the responsible persons by the law relating to the prospectuses. I now want to discuss civil liability. Civil liability. Under civil liability, we are looking at third parties. Any third party who suffers loss, any third party who suffers loss by reason of relying on an untrue by relying on an untrue statement contained in the prospectus. Any third party who suffers loss by reason of relying on an untrue statement contained in the prospectus. So they have received the prospectus, they have read the prospectus. The prospectus did contain a statement that was untrue, that they relied on to make a decision to subscribe for the shares of this company. It is as a result of that subscription that they are saying or claiming that they have suffered loss. They have civil liability both as at statute and at common law. They can claim both under statute and at common law. At statute, they are claiming for compensation. They will be claiming compensation for loss suffered, where under common law, they shall be suing for damages. They shall be claiming damages for misrepresentation. They shall be claiming damages for misrepresentation. It is also possible that they can claim rescission of contract. This is rescinding the contract of the purchase of the shares. That at common law, I bought shares on the faith of a statement that was contained in the prospectus, and this statement has now turned to be untrue. The innocent party, the suffering third party, may be claiming rescission of contract. I want to rescind the contract of purchase of shares on the basis of the misrepresentative statement, on the basis of the misleading statement contained in the prospectus. They could also be claiming damages, monetary compensation for any particular loss, monetary loss suffered. That is under common law. Then we are saying, as far as the Companies Act is concerned, it provides for a possible compensation that can be claimed by the suffering third party from specific persons. So who are these persons that we could be claiming compensations from? Persons liable for untrue statements contained in the prospectus. Persons liable for untrue statements contained in the prospectus. Now, we could be claiming compensation from every person who was a director, at the time of issue. Every person was a director at the time of the issue. We could also be claiming from every person who allowed themselves, to be named as directors, who allowed themselves to be named as directors. We could also be claiming from every person who had agreed to become a director, after some time. We could also be claiming from every person who authorized the issue, of the prospectus. Every person who authorized the issue of the prospectus. So that is the spectrum of all persons on which this civil liability is lying on them. And these are persons under the statute that we can be claiming compensation from. So class, that is the story of the prospectus. It should be bringing us to the end of this third class. Just to recap what we have done, we have looked at what the prospectus is. We have also looked at the essentials of a prospectus. We have looked at the contents of the prospectus, which are primarily supposed to give the potential investor all the relevant information they need in order to base their decision on whether they are going to buy the shares or not. Then we have also looked at the liability in respect of prospectuses, criminal and civil liability. This liability is for the purposes of ensuring the requirements of the Act in relation to the preparation and the issuing of the prospectuses have been complied with. Thank you very much. Hello class, welcome to lesson number 4 of topic number 5, share capital. So in this fourth lesson, I want to talk about the purchase of own shares, by a company. Then I will also talk about dividends, the dividend law in respect to companies. So let me begin on the first of those items where we are talking about by purchase of own shares, purchase of own shares by a company, purchase of own shares by a company, where we are asking ourselves the question, can a company purchase its own shares? Or could a company, by extension, finance the purchase of its own shares? Now, we notice that there is a direct prohibition against companies purchasing their own shares or financing the purchase of their own shares. At common law, this is the rule in Trevor versus Whitworth, where the direction of the court is that a company must not purchase its own shares. A company must not purchase its own shares. Now, this is consistent with the rules that relate to the company's maintenance of its own capital. That the company's capital is the creditor's fund of last resort, and as such should be maintained. And all those matters, all those transactions of the company that go towards threatening the company's share capital, transactions such as reduction of share capital, transactions such as the company's purchasing its own share capital, all these are extremely regulated transactions by law in a bid to ensure the company's share capital remains fixed and known, remains unreduced, that there are measures that have been taken to ensure that the company does not waste its own capital. Now, despite this direction that a company must not purchase its own shares, the Companies Act gives us some special exemptions under which a company may be purchasing its own shares. So these exceptions include exceptions to the rule, that is exceptions to the rule in Trevor versus Whitworth. These exceptions introduce us to circumstances where a company may purchase its own shares. Now, one of those circumstances is during a redemption of redeemable preference shares. During the redemption of redeemable preference shares. This is if allowed by the articles, and all rules relating to redemption of redeemable preference shares have been followed. Rules that we have discussed earlier, such as the shares being fully paid, the shares being redeemed either out of the proceeds of a new issue or if no fresh issue has been issued by the company redeeming them out of reserves and creating the share redemption reserve fund. We could also have a company purchasing its own shares in case of a valid surrender, in case of a valid surrender of shares, by a member. This is a rare case, but very much possible, particularly where a shareholder holds partly paid shares, that the shares held by this member are partly paid. The fact that they are partly paid, they present a further obligation on that member to make payments for the balance, for the unpaid part of those shares. In the case this member is unable to make these further payments, in the event that this member is not able to discharge this liability, this obligation to pay for the balance outstanding on their shares, then they can surrender such shares to the company. This surrender, in a way, is to absolve them from that liability to pay for the outstanding amounts on their shares. The other possible circumstance under law where a company would be purchasing its own shares would be following a court order for protection or for the purposes of protecting minorities. Where we have circumstances in the company, imagine circumstances such as a variation of class rights that is proposed and even voted accordingly, but we have some minorities who are contesting the variation of class rights on the basis that it is prejudicial to their own interests. We may have a court order directing that the interest of these shareholders, minorities actually, these protesting or these objecting minorities be absorbed by the company. In such an incident, the court could be directing the company to purchase the interest of these minorities, which the resulting transaction would be a company purchasing its own shares. So class, in these exceptional cases, they are presenting us to a scenario where we are going against the directions given by the rule in Trevor versus Whitworth, where the direction is a company must not purchase its own shares. However, we are saying in these exceptional circumstances, we can have a company purchasing its own shares. Now, by extension, we are also saying that a company must not finance or provide a guarantee, for the purchase, of its shares, must not finance or provide a guarantee for the purchase of its own shares on the same premise that we were not to purchase our own shares for purposes of capital maintenance requirements. However, we are also finding ourselves running into exceptions to this rule, that we have exceptional circumstances where a company may finance the acquisition of its own shares. Now, these exceptions include where providing finance or guarantee is part of the ordinary business of the company. So this could be a company in the financial sector where part of their business is the provision of financial assistance, that they're in the business of giving loans. So a loan has been obtained by a customer in the normal circumstances under which normal loans would be borrowed, where such customer also proceeds on to purchase the shares of this company with the proceeds advanced by the company. Then we have a situation, an exceptional circumstance, where a company has financed the purchase of its own shares. The other exceptional case would be where the company has a scheme, to advance, where the company has a scheme to advance money or funds to trustees, to a trustee or trustees to acquire shares, for the benefit, of its employees, Now, this exception presents us with a situation where this company has set up a trust fund, or has set up a trust for the benefit of the members. And this trust, part of the things it does is investments for the purposes of the members. Remember, these investments could be through the purchase of shares, securities in companies. So we are saying funds have been advanced to the trustees by this company, where the trustees invest for the purposes of the members' welfare. These trustees could proceed on to use these funds in buying the shares of this company, advancing the funds. Now that presents us with an exceptional circumstance where the company is seen advancing funds, which funds are subsequently applied in the purchase of its own shares. Then finally, we have an exception where the company has a scheme. The company has a scheme to advance funds to employees. This is with an exception of directors, except directors to purchase shares in the company, for beneficial ownership. So company law recognizes that companies could have a scheme, an arrangement within the company, that they advance funds, they advance money to the employees of the company, with an exception of directors. Directors are excluded from this fund. They are excluded from this scheme, this arrangement of advancing money to employees to purchase shares of the company for beneficial ownership. This scheme is to make the employees of the company feel part of the company, where they have been advanced money for the purposes of owning a stock in the company that they work for. So this is the idea of purchasing of own shares by the company, that it is generally prohibited in the interest of protecting the company's capital. However, we have seen ourselves running into exceptional circumstances where companies can directly purchase their own shares. We have also seen circumstances where companies are allowed by law to finance the purchase of their own shares. Let me now look at dividends. Dividends. We are describing a dividend to be a member's return. This is a member's return for their investment. A member's return for their investment in the company. A member's return for their investment in the company. It is also seen as a share of the company's profit, that is paid to the members. The share of the company's profit that is paid out to the members. Now, the Companies Act presents us with certain rules relating to the payment of dividends to members, relating to the sharing of profits or paying of this return to the members. Rules of paying dividend. Rules of paying dividend. Now, as part of this continuing story of maintaining the company's capital, One of the paramount rules relating to the payment of dividend is that dividends can only be paid out of profits. Dividend can only be paid. Dividend can only be paid out of profit. Dividend can only be paid out of profit. That unless a company has realized a profit, then this company cannot pay dividend. And by the way, inherently, companies are not under obligation to pay a dividend. It is financial year end, we have made profits. The company is not under obligation to pay dividend to the members. But we are saying, should we be paying dividends? Dividends must always be paid out of profit. It is unlawful. It shall be wrong. It shall be against the law to pay dividends where the company is not making profits. It shall be seen as paying dividends out of capital. Now, what will be considered profits? The company has what we call the realized profit, the realized profit of the company. Now, from the company's realized profit, it may create some part of this realized profit as the profits available for distribution as dividend. Now, in arriving at the company's realized profit, it could be considering any gains. We talk about realized gains. Any realized gains from revaluations. Any realized gains from revaluations of assets can also be considered as the company's realized profits in this year, including the exclusion or the deduction of any realized losses from revaluation of assets that this company has done during this year can be excluded from the company's annual realized profit that year. So from the company's realized profit, the directors will designate part of the company's realized profit as profit available for payment of dividend. Profit available for payment of dividend. The other rule is that dividend is recommended. Dividend is recommended by the board. Dividend is recommended by the board of directors. Dividend is recommended by the board of directors. These are the persons charged with the day-to-day management of the company. So they are best placed to know how much this company can afford to pay as dividends. So it shall be their responsibility to recommend how much dividend is to be paid. Still relating to the payment, we are saying that dividend is approved. Dividend is approved by members. Dividend is approved by members at a general meeting. Dividend is approved by members at a general meeting. Now, this meeting could be the company's AGM, at which dividend is usually approved by the members. So the directors have recommended a dividend, then we have a meeting of members where that dividend is approved. Relating to the approval, we are noting another rule that the members cannot recommend. The members cannot, let me withdraw the word recommend and replace it with the word approve. The members cannot approve a dividend above the rate, cannot approve a dividend above the rate recommended, above the rate recommended by the board. Above the rate recommended by the board. So the board's recommendation on what dividend is payable shall be final. That in the GM's, the general meeting's approval, they cannot approve an amount beyond that which is recommended by the board. We are also noting that the company cannot pay dividend. The company cannot pay dividend if such payment will result to inability to meet its financial obligations. A company will not pay dividends to be unable to pay its salary to employees. A company will not pay dividends to be unable to pay rentals. A company will not be paying dividends to be unable to pay such expenses as are necessary for the running of this company. Now, once a dividend has been declared, something also happens that declared dividends, let's add the approval, declared and approved dividends, shall not bear interest against the company if there is a delay, in payment. That the board has recommended a certain rate of dividend, which has subsequently been approved by the members at a general meeting. Now, the usual practice is that once the dividend has been declared and approved, within 42 days of such approval, the dividend should be payable. If there is any delay in payment of such dividend, the suffering members shall not claim interest against the company for delay in paying them the dividends due. The other rule, still relating to payment of dividends, is that the company may deduct any amounts. The company may deduct any amounts owed to it by a member from the dividend payable. That the company can deduct any amounts that they are claiming from a member from the total amount they are to pay them as dividend. For instance, imagine a case where we have borrowed some money from our company and we have been unable to pay them. We have not repaid such borrowed amounts of money. So this company has some claim against us. So this rule is empowering them to deduct such amounts that they are claiming from any dividend that is payable to us after the declaration of the dividend. Now, from these rules, we can start imagining a procedure that companies follow in the payment of dividend. What procedures do we follow when we are paying dividend as a company? We will begin from a board meeting being held to recommend a dividend. After a board meeting has been held to recommend a dividend, the company will prepare and update the company's register of members, because it is on the basis of the register that this dividend is payable. Then we shall proceed on to convene a meeting of members where this dividend payment is to be approved. So once the dividend has been approved, then we have a preparation and closure of the register of members so that we have no more additions to the register after the approval of the dividend. Then the company can proceed on now to prepare the dividend warrants, which are to be counter-checked against the company's register of members. Then checks can be prepared and sent to members in respect of the dividend payable to them. So class, that brings us to the end of our lesson number 4. If we can recap what we have looked at so far, we have looked at the purchase of own shares by a company, where expressly such purchase has been prohibited, including the financing of the purchase of the company's own shares. But we have also looked at exceptional circumstances where such purchase can be done and the financing for the purchase can also be done. We have also looked at dividend, what it is. We have looked at the rules relating to payment of dividend, and we have also made a mention of the procedure to be followed by companies when paying dividends. I now want to send you to the revision partner questions, just to show you some of the questions that we have had from this particular topic. We have a question here asking candidates to advise shareholders on the distinction between nominal capital and reserve capital. We have a question asking candidates to explain 5 ways in which a company might alter its share capital. We have also a question here asking candidates to discuss the actions and omissions that are considered to contribute to criminal behavior in relation to preparation and issuing of prospectuses. So there are many questions here that I would wish to refer you to help you in the revision of the content in this topic. Thank you. Hello class, welcome to lesson number 4 of topic
Hello learner, welcome to Manifested e-learning platform. My name is FAM Lingwiri and I practice within the financial services industry in Kenya. Today we are discussing on the financial modeling and data analytics paper. The focus is on the December 2023 sitting. We are going to discuss on question 21. The question reads as follows. Eugene Shahira has been provided with a set of historical data by one of his clients, which include a set of assumptions, statement of comprehensive income, statement of financial position, statement of cash flows, and supporting schedules as presented below. And so you can see down here the assumptions. These are the assumptions that have been given to us here, and you can see they're presented in blue for the forecast period, and this is the historical results. We have the income statement, the balance sheet given to us down here, and the cash flow statement just under it. Finally, we have what is called the supporting schedules. We are required using the assumptions presented in the assumptions table, assist Eugene to complete the following statements of forecast period for the forecast period. A, the statement of comprehensive income, the statement of financial position, the statement of cash flows, and the supporting schedules. All of these total to 30 marks. So we go back up and start filling out the income statement based on this forecast period right over here. So the forecast period is from 2017, and we are going to start with the income statement. So the revenue, to model revenue, we have been given the revenue growth rate over here. And so we are saying that we are going to assume that the revenue is going to grow at 5% initially, 4.5%, 4%, 3.5% and 3% in 2021. So we will increase this 150,772 by a factor initially of 5%, 4.5%, and so on and so forth like that. So let's do that together. So the first thing is to link it with that, and then we multiply by that factor 1 plus now this growth rate right over here, and we close the bracket so that now the model can be complete, or the formula can be complete. You can see in 2017 we expect it to be like that. So we drag it, Control R, and it picks the formula like that. Else we can do the following. If we don't prefer to do it like that, we just focus it like that, and we wait for that plus sign over here like so, and then we drag it like that. So we drag the formulas, and you'll still see the answers are the same. How do we model cost of goods sold? Now we are told that the cost of goods sold is provided as a percentage of revenue. Meaning what? We get the cost of goods sold over revenue gives us 37.5%. I can do it right above, right beside it here. So you can say COGS over revenue will give us the COGS percent, which is this one right here. But how then can we use the COGS percent to be able to model the cost of goods sold? We just get the revenue and multiply it with the cost of goods sold percent, so that now we can be able to model the cost of goods sold, because that is what we're going to remain with over here, because cost of goods sold over revenue is cost of goods sold percent. So we cross multiply the revenue multiplied by the cost of goods sold percent, then we should be able to have the COGS, and that's what exactly we are supposed to do. We take that and we multiply, or the revenue, we multiply that with what is called the cost of goods sold percent as a percentage of revenue. Enter there, and like the same way we've done before, we just drag it, Control R. The gross profit, because it's a formula, we just drag it, Control R. Now we move on to the expenses down here. So the salaries and benefits, what are we told as far as the assumptions are concerned? We are told that the salaries and benefits are given to us in terms of shillings, 25,000 all through like that. And here we're saying it's going to remain as 10,000 in terms of the depreciation component. So because they're following each other like that, and these are considered to be fixed costs, we just pick them from above. There, just pick it up from there. And also because they're following each other, just drag it like that, put it like that. And then now, fill it out like that. What I've just done, I've just picked this one from here. And you can see from here, this is I-32. Like that. So it's I-32, which is this cell over here. But now, where do we pick it from? We pick it from I-13. This is I-13. I-13 is this one here. So we're picking it just from there. And then also this one is going to be I-14, which is down there. Now we move ahead and try and model the depreciation and amortization. In real life, trying to model depreciation and amortization will prove to be a bit of a challenge. Determining or will be a bit of a challenge because we need to know whether it's going to be reducing balance or whether we're going to use straight line method. For simplicity's sake, the way I've gotten, I've seen it right over here, depreciation as a percentage of PPE, it's just based on straight line method like that, for simplicity's sake. So the depreciation and amortization is driven by percentage of opening balance of PPE. So we will initially leave it over here because we do not have the values of PPE given to us directly, and we'll model it a little later on. As well, the interest right here, the interest right over here is based on opening balance. We do not have the opening debt balance given to us here. So what do? We first of all leave those two alone like that, and we will be able to try and model them a little later on. So we put maybe say a faint color there on them, like so, to show that we're going to come back to it a little later on. Because these are totals, the ones in black are always totals, the ones in blue are hard coded values. We just drag them. That. Remember that this value here is bound to change as well as this value is bound to change because of we've not filled out the depreciation, neither have we filled out the interest. Now the taxes over here, we have been told something about the tax rate right above here. You can see the tax rate is as a percentage of earnings before tax, and you can see it's 28% all through. So what does that mean? That this tax rate will be based on that value times the taxation rate which is given to us right here. So we link it with that one there. And because this is also going to change based on these values given to us there, we just drag it, and because Excel is very wonderful, it's a very wonderful tool, it will just pick everything, or it will pick the formulas based on the values that are inserted right at this point here. This is a formula, so we just drag it like that, moving towards the right. So we have partially filled in the income statement with the exception of depreciation and interest expense. We move over to the balance sheet and try and model it and see if we can be able to model some items. Cash will be the very final part that you're going to fill out, and it will be like what is called the balancing figure as we approach the end of the model itself. How do we model accounts receivable? The accounts receivable, if we can go back to the assumptions section over here, this is the assumption section right above here, you can see we've been given accounts receivable days. We've been given 18. And accounts receivable days is driven by revenue. So it is accounts receivable over revenue times 365. We can get this from these black formulas over here. So if we double click, you can see it is the revenue, or it is rather the accounts receivable, yes, if you said before, accounts receivable, We divide that with the revenue, and then we multiply it by 365 to enable us get the days. Now that we've assumed that the days are going to be 18 over here for the forecast period, and you can see this is the forecast period here, 2017, how do we model the accounts receivable here? We are going to move ahead and say that it is accounts receivable, like that, is given as how we're going to model it over here. We'll pick the revenue, because we've said that we already have the accounts receivable days, and then we divide that, or rather, let me just tell you what you're going to do, because the formula is given to us right over here. You can see this is it over here. We are saying we're going to get the revenue, or rather the accounts receivable over the revenue times 365. So we're just going to do this. We are going to pick the days over here, accounts receivable days. So accounts receivable is going to be given as the days, and then we multiply that with the revenue, and we divide this, all of this, by 365, by 365 over here, 365, that. So days times revenue over 365. We've just adjusted the days. Initially, for us to get the days, we are saying we get the accounts receivable times 365 over revenue, just rearranging this formula. And that's exactly what we're going to do over here. We get the days are here, see where they are, just a second, accounts receivable days, there, and then we multiply that with the revenue, then we divide over 365, and we have that value given to us there. So shift control R, we model that. Inventory is driven by cost of goods sold. So in a similar fashion over here, the formula here, we'll get inventory is given as, or given by, the inventory days times COGS, not times revenue, and here we're dividing against 365, that. So that's what we expect over 365. So that's what we are going to do. We pick the cost of goods sold there, just to double check, cost of goods sold times the days. Which days? The inventory days right here, 73, divide by 365. Once we divide that by 365, then we should be able to get the 11,715. We drag it. PPE, or property, plant and equipment. Remember, this is the one that is going to drive our depreciation component over here. But since we don't have it yet over here, we leave it out for now. The second time coming down, we will be able to fill it out, because this is a formula. So shift control R. We can proceed on to the liabilities. Obviously, these values are bound to change because we've not filled out the cash, neither have we filled out the PPE. So the accounts payable is driven by cost of goods sold. Same fashion, the same formula over here, only that we're going to put now accounts payable. Now over here, payable. Payable for revenue 365. So we look for the accounts payable days, accounts payable days. You can see the accounts payable days are here, 37. And then we multiply that with the cost of goods sold and then divide by 365. That's what we get. The debt, we will be able to fill out the debt and link it with the debt component from the supporting schedules. So here we drag it like that because this is a formula here, it's just the total. So this one I'll put it in a different color so that for consistency's sake to maintain to show that this is the part you're going to come to later on and fill it out. In terms of the equity capital, we are going to link it. So we're going to drive it previous equity capital, then we add any new issuance and repayment of equity. So we come back up over here to the assumption section, this assumption section. Was there any issuance and repayment of equity from 2017? There is what we link it with over here. And we enter. The retained earnings is driven by the previous retained earnings plus the net earnings for the current year, which is this one here. Remember, this value is going to change because of these two, depreciation and interest. Enter. We drag them towards the right. And this one remains like so. So shift, Control R. So it picks the formulas as the way they are. Remember, in a balance sheet, we always have a check. This check, with your permission, it will obviously not balance because we are saying that here we have got some missing items. You can see it's not balancing at all. But it's up to our responsibility, based on what the examiners asked us, to fill and ensure that this one balances off, the balance sheet balances off, based on the forecast. Now, as far as the cash flow statement is concerned, we will first of all ignore it for now. We ignore the cash flow statement and we will be able to also do a check for the cash flow statement and write down over here to determine if we are actually cooking figures or not. We jump onto the supporting schedules. These supporting schedules are broken down into three: the working capital schedule, the depreciation schedule, and the debt and interest schedule. These schedules, these three of them, are instrumental towards filling in the missing items in the balance sheet, income statement, and the cash flow statement. So from here, the accounts receivable. You remember we had modeled it just above there in the balance sheet. So we just fill it out, link it with the one accounts receivable here. And you can see the accounts receivable is here, so we link it right over there and we put enter. Because they are following each other with the inventory, I can just drag this sort of down like that and it picks from above. The accounts payable, we also had filled it out or computed it above from the balance sheet here. The accounts payable, as you can see right over here, is 5938. You see it's okay. Link it like so. Then these are black. It means that they are formulae. To get the net working capital, we get the accounts receivable, we add the inventory, and then we less the accounts payable. That's how we get the net working capital component. So just put it like that and it picks. The change in net working capital is the difference between changes in this year from last year's. You can see the formula there. This value subtracting that value there. So I'll initially fill it like that. Then now I can drag it moving down like that. Shift, Control R. So once we have those values given to us there, we are saying that now the working capital schedule is complete. The change in net working capital is going to be useful in computing some items in the balance sheet or in the in the cash flow statement, pardon me. So we move down to the next supporting schedule, depreciation schedule. Now we can see something that is very unique from the historical values here. This value, which is the opening PPE, is there picked from the closing value here. This value has been picked from the closing value here. This one has been picked from there. So it goes without saying that this value here will be picked from the value there. How much is our capex? Our capital expenditure is representative of how much money we are going to spend out within the year. Outflow of cash, maybe to invest in new machines, new equipment, so forth. And we will link this with the supporting schedule up from, rather not the supporting schedule, the assumptions section, this one here. And we are saying that the capex, capital expenditures over here, is given to us there. So we link it with that and we press enter. The depreciation is based on the opening PPE always. So pick the opening value of PPE and multiply that with the depreciation rate. Remember, we are saying that we are assuming it for simplicity's sake is going to be straight line method. So depreciation, and we are saying we are going to multiply it with that. And we get that. To get the closing PPE, we are saying we are going to get the opening PPE, we add the capex and less the depreciation on the machines. So we drag the formula moving to the right like that, and we can sort of pull the formula towards the right or drag it. Now the final supporting schedule is the debt and interest schedule here. How do we model it? The debt opening, just like the way we are done in the opening in the depreciation schedule, this value is that value, that value is that value. So it goes without saying this value is going to be that value. So pick it from there. And the issuance and repayment of debt can be gotten from the assumptions section, which is up above over here. So debt and issuance repayment right now here, we link it with that. So here, because it's a formula, we just drag it. So we drag it over here, it's like that. We wait for the plus sign that looks black like that, which is over here like this, and then we sort of drag it. We just drag it moving towards the right. How do we get the interest expense? The interest expense is based on the opening value times interest on the assumptions section. Interest as a percentage of opening balance here is 3%. Now our schedule, or our supporting schedule rather, is complete. That's what we're saying we're going to do. We drag it. These values over here are going to be instrumental towards filling out the cash flow statement. But first, let's go back up and start all over again from the income statement here and fill out what is missing. We have the depreciation component, so we link it with the ones in the supporting schedule. So we go down on here, and you can see the depreciation is given to us over here. There, enter. The interest expense right here, interest expense is linked to the supporting schedule here, right here, enter. Then we can be able to just drag it towards the right there, Control R. And in a good account or analyst format, we just make sure that this part is the same color because we've already filled out the missing items and our income statement is complete. Now, like I said before, that the cash is going to be filled out at the last, at the tail end. It's like the balancing figure. We can fill out the property, plant and equipment. So, we're saying it's going to be from the supporting schedules down. So, we are saying it's going to be this value here, the closing. You're reporting at the end of the financial year. So, we pick the closing balance there, and we drag it towards the right. Remember, it's just the sum of all of them. As well, the debt, we pick the closing debt, which is right here. Closing debt should be that. We can just drag it, Control R. So, we can then of course now remove the theme color, put it here like so, with the exception of the cash. Now, let us fill out the cash flow statement. Net earnings is picked up from above here. Here 35 is here, the net earnings, you can see the net earnings is there. Here we have the depreciation and amortization over here. Right here, so we pick that. And then we are saying changes in working capital. Where do we pick it from? We pick it from the supporting schedules right here. Change in net working capital, and we are saying we are going to pick that value. So, because this is black and it's a formula, I can just drag it like so. Now, we are almost there, but we are not there, quite there yet. The investments in PPE represent the capital expenditures. So, the capital expenditures down here, capex, you can see the capex is here, link it to that. And this one, sort of pull it towards the right, and it's complete. As far as the financing cash flow is concerned here, issuance and repayment of debt, we link it with the supporting schedules, rather with the assumptions tab, sorry, up, debt here. And remember, they are following each other with equity. So, like that. And this can be dragged like so, because it's a formula, and we can complete this by doing that, by dragging the formulas, moving the right. The net increase or decrease in cash is a formula, because you can see it right above over here. We are going to add cash from operations. We subtract cash from investing, because that's money going out, and then we add cash from financing, so that we can be able to get the decrease or increase in cash. Drag that towards the right. And we are saying that we can then pick the opening cash balance. Remember, this opening cash balance is the closing cash balance here. This one is that one, and that one is that one. So, we are saying that we can then link that with that value. This one is a formula like so. So, we can then drag these values moving towards the right, and we have the values like so. Now, to try and test and see whether this is actually going to balance, because we are through, answered the statement of comprehensive income, statement of financial position, statement of cash flows, and the supporting schedules, we can see that it's still not balancing. Remember one thing, what I had mentioned, that the cash balance is the one that is the balancing figure right here. So let's try and see if you're going to link it, if it's going to balance. So we link this cash value with the closing cash balance right here, this one here. And you can see it has balanced. But dragging the rest towards the right is the one that's going to tell us whether we are on the right path. And you can see it has balanced very well. The cash flow statement has also balanced as well, meaning that we have successfully answered the question presented to us by Kasneb. We hope that you've enjoyed this session of ours, but before we part, there is one thing that I want to try and see and to ask you, whether even if we change these assumptions here, whether it will still balance. It will still balance. That may be the question. So even if I put this to 25 million, like that, and leaving the rest the way they are, look at the balance sheet. It still balances. If I put this to maybe 50%, that it still balances. So this issue or this idea of cooking figures cannot arise because Excel is truthful, and being a true financial analyst means that you need to know how to model all of the three statements, the income statement, the balance sheet, statement of cash flows very well. Thank you for being with Manifested Publishers, and God bless you.